you all hear me clearly, or you need to change,
Yes,
increase the volume?
No, we can hear.
Okay. Okay, we'll give another few minutes for, I can see about 20 people who have logged in. We'll give a few more minutes and we'll start off.
Sure. By the way, can I ask a question?
Sure, please go ahead.
Question.
Yeah.
When it comes to this, of course, when it comes to treasury operations,
yes,
including back office, front office, middle office, what could be the accounts that we can consider as suspense accounts, and how can we identify suspense accounts related to treasury operations? Like maybe, I don't know.
When you say identify suspense accounts, what you mean is non-customer accounts that are used for the bank's own internal purposes.
No, banks, the accounts which use by the bank for internal purposes.
Okay,
that
so when
temporarily you could, yes.
Okay, so what do you mean by identify suspense accounts? I'm sorry,
identify by suspense account in the sense like first we need to demarcate this account is actually a suspense account. Then you need to do a like monitoring mechanism, like if it is need to be daily zero, if that account carries a balance, someone need to be reconciled, something like that.
Correct. That's correct. Yes, that's correct. So generally, suspense accounts are opened as temporary accounts to facilitate transactions. Usually, when there are no client accounts that are available, right? Now, for example, in most international banks, they have, I think, from my own experience, discouraged or discontinued using suspense accounts unless it's a real requirement. And most clients have to have their own account. But I know from the past, my past experience, you generally have a different suspense account to route transactions through when a client doesn't have their own account, or for some reason that account can't be used for that particular transaction. Generally, it comes with a different sort of number sequence. Now, for example, if an account starts in a bank at 001 something, this might start with a 009 or 008. So generally, a bank has to have a separate sequence for that particular account type. That's one way of identifying it. Other way is basically at the end of the day, there has to be a record kept of all the suspense accounts open, and like you said very rightly, that has to be zeroed either at the end of the day or end of a certain period of time once that particular transaction has been facilitated. Now, unfortunately, how you identify it and what you use for it will be based on the technology you have and also the internal controls you have in the firm. Sometimes, if it's a manual process, it can be very dangerous because you can always lose sight of the existence of that account. And if that happens, only when there's an audit or some sort of a review or some sort of issue will it come up. So you're right, there has to be very strict controls. Generally, what happens is the Treasury middle office, the risk people, or in certain cases the back office, will do a balancing of the suspense accounts that have been opened, and that report will enclose, and the report will be sent on the next day to the head of the department, who will then ideally have to ask a series of questions as to why this account was opened, what was done with it, and confirmation that it was closed. Then usually in the governance meetings that you have, governance forums that you have in the bank, you would actually table certain types of accounts that have opened, and it depends on if it's a frequent thing or not, and why it was open and how it was sort of managed out. But it is not a normal series of events. That is what I'm saying. So I think that control process has to be there. Identification will depend on each of the companies, firms, and how robust they are for it. I can't give you one single answer for that, unfortunately.
Okay, the simple what you can do is you can take the balance sheet and you can identify the assets and liability accounts.
Yeah.
Maybe of course like liability asset accounts could be a suspense account.
Yes, I mean,
You
if
can
there is an account that is there that is not demarcated for a particular client transaction or a transaction, generally it
okay.
is a suspense account. Because what are you talking when you
Okay.
say suspense account? Like I said, you're referring to accounts that cannot be routed through the bank's
Yes.
existing, double entry or account systems or the client accounts for
Yes.
whatever reason. So you are
Yes.
opening it now. Like I said, those days when there were certain transactions that banks could do, and the customer can't. I'll give you an example. If you say foreign exchange, there is the ability that customers have to buy foreign exchange at another bank and bring it to a bank that they have their import bills or retirement. So they, for the benefit of the rate, they can buy it somewhere else and bring it. Some of those banks that they open, try to buy the foreign exchange from, don't necessarily have account for the client. So in order to facilitate the transaction and to facilitate, say, the rupees coming in to settle the foreign exchange, the bank will route that transaction through a suspense account. Now, when the rupees are converted to dollars and the dollars are paid to the bank that has the bill, it is important for that bank to basically ensure that suspense account is everything else being equal, is zero, and there is no residual rupees in that account. But that, like you said, will depend on the balance that a daily balance that the operations people will do, and then a T+1 balancing that say the head of markets or whoever gets his hands on, and then a monthly assessment to see whether there were any suspense account breaks, suspend account, whatever. So what happens usually is you get a set of key risk identifiers. The key risk identifiers will tell you what the suspense accounts open were and if there were breaks in those suspense accounts, if there were any unusual activity in that. So that is a control you have, but happens on a D+1 basis. But those controls have to be put in place. It just doesn't happen. You have to be able to go in, look at it, and identify where the gaps are and put sufficient controls in place for that.
Thank you.
That was Ruchira, right? Who asked the question? Sorry, I didn't get your name.
Yes.
Yeah.
Yes, Ruchira.
Okay.
Ruchira.
Thanks, Ruchira.
Thank you.
Thanks for the question.
Okay.
I will start off. Okay, good morning to everybody. Well, so as you can see, I'm back for the asset and liability management piece of the course program. Again, unfortunately, we have not been able to meet physically. Hopefully, I need to speak to the institute, but we may have physical classes soon, but I have no idea when that will be. In the interim, we have the ALM course what we're doing now. So the idea would be for us to complete the ALM program, and then I think we are looking at giving you guys an assignment, which we will share with you once this ALM section is over. We need to see whether we finish that section also and then give you it. But basically, ALM will be completed before we give that assignment to you. Okay, so for ALM itself, I have a series of around 4 or 5 presentations, 5 days. The slides that themselves are the set that we have is quite extensive, and I will not tell you that we finished the first set on the today and next set tomorrow, next week, etc. We'll take it as it goes in terms of based on your understanding, the interaction I get from you, and assessment in general that we are all comfortable with what we are seeing. It's not a difficult section. I think some of it later on in relation to duration, convexity, I think Nishanta has already touched some of those areas as well. Basically, today's one is relatively, just basically the start of the on basic understanding of what ALM is, how the bank basically looks at ALM, and moves on from there. First and foremost, can you see the presentation on your screens?
Yes, sir.
Okay, it's clear, right? I mean,
Yes, it was clear.
okay, great. So let me start off with basically ALM, the abbreviation, asset and liability management, right? So we are trying to understand today what we refer to as asset and liability management. In some banks, they called it, BSM, balance sheet management. Certain banks, they call it asset and liability management, but it's basically the same thing. So as you said, the outline, we are looking at the definition. We are looking at financial risk. We are looking at ALM not only as a risk management tool, but as a management tool overall in terms of profitability, as well as risk management and liquidity management. We are looking at a bank, what the scope of it is, and what ALCO is. ALCO is basically the Asset and Liability Committee, which more or less defines the ALM strategy of the bank. And then basic framework of how ALM sits within the overall risk structure and how it is used in practice. That's the basic outline of ALM today. So these are just two books that has been put in here. On very honestly, this was put in by my previous lecturer, Ratna, in terms of overall banking, and it covers a bit of the ALM bits as well, and that's why he's mentioned it there. So if you have the time, please do see whether you can get the books and read through it. It'll give you a good overview of the subject matter and in general banking as well. This is Mark Twain saying, so what it means is the banks are there when things are good, but if things are bad, you might not see them around in the same way. And you will understand there's a meaning to that afterwards. So okay, so most of you, I think, have a finance background, have probably done an accounts background, degree or accounts subject at least over your course of your studies. So you know what a balance sheet is. I'm not going to go into that. So basically, what we look at is in a balance sheet, generally, we are looking at the banks, whatever the firm's assets and liabilities, and the composition and the composition of those balance of those assets and liabilities. So in a case of a bank, what are we looking at when we look at the balance sheet? We are looking at a few things. We are looking at to see, okay, where is the bank funding sources and where is the bank deploying its money? We see that by the quality of its assets and liabilities on its balance sheet. And can you tell me why that's important? Just to start things off, why is it important for us to know where the bank is funding its, where its funding sources are and where it's investing in? Just very basic, without going into too much technical detail. Why is it important for you and I, if we are shareholders of a bank, forget being employed in the bank or anything else, if we are shareholders of the bank, why is it important for us to know where the funding sources are and where the bank is investing its money? Very general question. If you just think about it, if you are, forget a bank also, if you are owner of if you are owner shareholder of any company, what would you look at the balance sheet to see of that company?
To understand what is the assets and the liability of the company.
But why would you want to see that? If the company is making profits and that profitability is coming into, they're paying you dividend and everything else, but why would you want to worry about the assets and liability of the company?
Maybe if they have good capital,
Yes, very good.
tells
Yes.
you that you can absorb anything, any unexpected events could
Very
occur
good.
in
So
the thing.
you want to see how much of capital adequacy they have. Very good. But from a okay, that's from a overall perspective. Why else would you want to do it? It also gives you a picture of how sustainable the business is. It tells you for the volume of assets they have, for example, of deployed, say if in the case of a bank, if the bank has X amount of assets, how much of it is managed through liabilities that will be there for a longer period of time? How much is coming because of its equity? How much if it's coming because of debt? So to understand whether this business that is being carried on can be sustained as well. And like you said correctly, from a capital perspective, if there is a stress situation to the balance sheet, can that company handle that stress situation? A company can be making profits, that's fine. And that you can see in its income statements and all that, they can be making profits. It could be because of the product they're selling and the demand for that product, and their position in the market, the profit margin they have overall on that product. Could be various reasons. That doesn't mean necessarily that company can sustain that if it is highly leveraged or not leveraged enough where it can sort of step up to additional demand, etc. So it gives a impression to any person looking at it. What is the capacity this company has to maintain the level of business that is maintaining in a successful manner? So, like what it says here, in the case of a bank, it shows you in a very basic sense the composition of funds, where is the money coming from, and where is the money going to in that bank. So, next slide number 6. You see what I mean there. You see the bank can raise funding from many sources. Most traditional of it will be deposits from the public, but it can go to non-deposit borrowing, say from the interbank and things like that. And of course, if it's a listed company, equity from its shareholders, or even its private equity. It can be private equity. It can be basically equity financing coming in to raise funds. So that's where the money comes from. In a very simple way, that's where the money comes from. And the money is lent to. What is it lent to? Loans and leases, the common thing that any bank, core business of a bank. Investment is securities, treasury bills, corporate debt, debentures, etc., etc. And basically, the bank could also hold it as cash and deposits in other banks. Cash in the vault becomes an asset. Cash in other banks, cash at central banks become an asset for the bank. So at the end of the day, before we go anywhere, this is the core of it. The bank has liabilities it has raised from its depositors and others. The bank has assets it has deployed to its in various forms. How does the bank determine what is the right mix of these assets and liabilities? How much of liabilities should it have to its assets that he has? Remember, the balance sheet has to balance at the end of the day, right? So if I take a 100 rupee deposit, what do I do with it? How do I make sure that I can pay the deposit interest rate that is there to the depositor, as well as make my minimum profit on that deposit and pay my shareholder his dividend and basically cover all other costs with it? It has to be by way of an efficient deployment of that deposit, of that liability to the right assets, whether it be in a loan, whether it be in an investment, whether it be simply, deposited in another bank for some other reason. So that is what ALM is all about. How do you manage your balance sheet in the most efficient manner? So going more into that, if you look at the bank's assets, you can break it into 4 simple areas. Like I said, cash in the bank. So basically the money that is in the vault for depositors to, when you get money from your depositors or when you are giving money to cash withdrawals, the money you keep in the vault for that purpose. Government securities and private investment bank securities, like I said, treasury bills, treasury bonds, corporate debt, commercial paper, etc. Loans and leases, so basically loans made out to your customers and loans made out to other banks. And miscellaneous assets, so like in any other firm, a bank will have its plant, equipment, its buildings, vehicles, whatever it is. So Basically, bank has to decide where he puts all that assets into, all those liabilities, and obviously that will be a smaller portion of a firm, because ultimately, unlike a manufacturing company or a retail company or whatever that might be, the bank has very little fixed assets. Its main cost would be coming from its employees and the services it offers, rather than from its plants, buildings, and firms. Yes, there are banks and firms that have those, but those are more legacy issues. The more and more you find that most of these are leased and not owned by the banks. And the two principal types of deposit liabilities are deposits and equity. So when you look at deposits, you have these deposits by your customers, and other one is non-deposit funds in money and capital markets. So basically, you can raise money from the capital markets by issuing treasury bills and bonds, by basically borrowing in the interbank market as well, issuing all kinds of debt basically, and equity capital raised from your shareholders. Okay, any questions, please? Is that clear? Or need more clarity? Okay, fairly simple. So basically, now you have the balance sheet, you have your deposits, you have your assets. Now, once you have that, do you just deploy your funds that you have got and wait every day and say, okay, this is fine, I've done what I have to do, that's enough? Is that what the bank does? Takes a deposit today, puts it on a security, and they say, okay, fine, that's it, I'm done for the day. Till those deposits mature, I'm happy to just sit around and wait. Is that what the bank does? Does the bank take a deposit to deploy the money and just hang around and say, okay, look, I'm going to wait for the funds to mature and the assets to mature, so I don't need to do anything else? Does the bank do that? Or is it a dynamic process?
A dynamic process.
It's a dynamic process. So the banks will every day make decisions on, they look at their current composition of assets and liabilities, and every single day they will make a decision on, okay, is this good? Is this bad? Shall we change our mix? Shall we buy a security, sell a security? Shall we make a loan? Shall we take more deposits? How can we be funded something for an investment for 5 years? Do we need to fix the interest rate on that? There are various decisions the bank will keep taking on a day-to-day basis based on the information it has at hand on the look and feel of its and the basic composition of its balance sheet. So it's important to understand it's a very, very dynamic process that happens on a day-to-day basis. So now, decisions on whether, first thing you got to understand is why the bank is making those decisions, and secondly, what factors go into their decision-making process. Okay, so when looking at the balance sheet, the bank will make decisions to enhance returns for the bank, enhance returns as well as manage its risk. Is that the same thing or different things? Managing risk and enhancing returns, if somebody told you that, is it same or different? Those two facts. What do you think?
Two different things. Two different things.
Two different things, but equally important from a bank's perspective, because returns dictate the fact that the company can continue to operate at a minimum profitability level, and also make sure that their shareholders are happy to be shareholders. continue to buy the share and hold the share of that company. So their return requirement is very, very important. And the other one is risk management is also important to make sure that this return is made in a proper, controlled, fair, transparent, and efficient manner without taking undue risk to the depositors and people who've given and equity holders and all that who've given money to the bank. So every single day you sit down to look at your balance sheet, you will think of how can I maximize my return at the same time, like how can I keep the company safe by doing that, while doing that. So the decision you make on the balance sheet is based on a few things, not limited to, but if you look at those 3 points there, number one, outlook on interest rates. What do you feel, say, the rupee interest rates are going to do today, tomorrow, next month, next year, into the next 5 years or whatever? Composition of assets and liabilities, meaning at this current moment, what are the liabilities I have? What are the short-term liabilities I have? What are the long-term liabilities I have? What are the long-term assets I have? What are the short-term assets I have? How good are they? Are they assets that can and liabilities that can be taken out easily by the people who own it? For example, do I have 5-year deposits, which is a liability that can be uplifted very soon without any penalty? So there, am I at a risk of, although I think it's for 5 years, of losing it in a year? And what is the cost of me losing that kind of information? And then your risk-taking appetite, meaning, are you a firm that will go out and take a risk? Are you happy to sit down and manage things? Or if you have a strong view of something, are you willing to take a risk? Are your shareholders willing to give you that ability to take the risk? In other words, is the board of directors happy to let you take that kind of risk? So, but there are other decisions as well. It could be currently, for example, if I would tell you market situations, like market stress situations, when you feel there is a liquidity issue in the market, when you feel there could be a funding constraint overall in some currency, all those factors will go in, and there is no one clear reason. So, for example, if you take this year, and what we are doing these lectures now like this because of COVID, right? COVID, and then do a COVID period, if you are going through a pandemic now. The bank has to make sure that in this current period, every day it sits down and say, okay, during this period, do we have a risk on our balance sheet? Is there a risk that people will take deposits out and use it for their personal? So, in that way, are we losing liabilities? If so, how do we make sure we fund ourselves sufficiently over this period of time? What is the view on interest rates on that time? How long will this pandemic continue? If so, how should our balance sheet look based on that? So all of those things have to be considered, and there is no one unique answer as to how you do it. But these are just an example of the common things you will look at when you go in and look at your balance sheet and decide how to manage it basically on a day-to-day basis. So, like I said, the process of making such decisions about the composition of assets and liabilities and the risk management framework you work on is there. Don't worry about slide number 12. Okay, so what I've just told you, in essence, is described in slide 30. So you can read that later, right? But everything I've said to you is basically encompassed in that slide. What are you saying? The bank will manage its assets and liability to increase profitability and capital and basically give its shareholders a maximum value while taking the right amount of risk, and basically the risk that is the board of directors believe is acceptable for the type of business that the bank is in, and also while doing that serving its community, etc., etc. Right? the responsibility of managing this assets and liabilities of banks sits with the bank's assets and liability committee. Okay, I'll stop there for the moment. Please, this is important because this is the starting point. Can you, if you all are not clear, please do let me know, and we will then move on from that point. Is everybody else there or sleeping? Are you all up Sunday morning, having a good nap still?
Yeah.
Yeah, sure. 30 people.
Yes, sir.
I would say about 27 of you all are sleeping. I would be. Okay. How are you all enjoying the Zoom sessions, or you all prefer the classes?
Zoom also good, like at home.
But is it effective enough? Do you all understand? Is it clear?
Sometime when it comes to sums, like it will take some time us to understand, like personally for me. But when it comes to theory things, it's okay. Like always the clarification could be obtained. No?
Definitely, yes.
Anything,
And you have the correct, and you have it all there for you. You can always go back and refer fast and all. No, I think it's good, but it all depends on the person as well, I think.
yes, of course.
Okay, any questions on it? I'll move on to an example, and then we can understand it further if there's no other question. Okay, so next slide number 14. It shows you basic, what we've been discussing all this time. A bank borrows $100 million at 3% for 1 year, lends the money at 3.2% to, say, forget the rating, 5 for 5 years, so 3.2% per annum and 3% per annum. So the question is, if I were to ask you, the next slide, bank has borrowed 100 million, lent 100 million. So equal amount of money has been borrowed, equal amount of money has been lent. What is the NII for the bank on that? Net interest income. So what is NII first and foremost? What is NII?
Like, that is
Just go ahead. What is it?
net interest income. Like,
Net interest income. Net interest income. So when banks keep talking about the NII going up, NII going down, what are they actually referring to? Have you heard it? When the bank talks in their book, when you hear the annual, you just look at the annual reports, or when you go to their AGMs, they say, okay, NII has increased, NII has decreased. What is the bank talking about from an overall perspective?
that is basically the margin.
Correct. Margin between what?
Margin between
interest expense and interest income.
Correct. That's right.
Yeah.
And that is taken at a, now in this case, we're looking at one example, but what is it taken at in the bank's perspective? It's taken at a portfolio level, meaning you saw all those deposits that we raised, we were talking about when we looked at liabilities, all the different type of funding sources, and you saw all the different type of asset sources the bank can have. At a portfolio level, when you take average or weighted average or whatever you want to call it, of those deposits against the portfolio of assets that you have, they will say your net interest income has been 5%, 4%, 3%, whatever. So if your net interest income has increased, is it good or bad for the bank?
good.
It is good, because it shows, what does it show? Coming back to ALM and this particular session we're doing today, if your net interest income has increased, what is it demonstrating to the shareholder, to management, to the board of directors, whoever it is? What is it demonstrating? Looking at ALM and somebody says, look, my NII has increased by 5% to 7%. What is the first thing that you would think from an ALM perspective?
You are managing your.
Go ahead, please. Yes.
Efficiently.
You're managing your. I think it was not clear. Sorry.
You're managing your funds efficiently. Basically, the borrowings what you have got from the deposit
Borrowings
center.
as well as lending. So, in other words, what you're saying is correct, 100%. You are managing your funds perfectly. You are efficiently managing your balance sheet, and you are making sure that your net interest income is healthy. Now, I'll ask you another question here. Yes, so fine. So this guy has borrowed at 3%, 100 million. He has lent at 3.2%. So first and foremost, for the first year, what's his NII? Only on this particular deposit.
0.2%.
0.2%. Now, what's the NII on the second year?
That could be difference between the borrower's bank. In this case, bank borrows USD 100 million for a year, but it is lent for 5 years. That will depend on the next year's borrowing rate.
Exactly.
That
Very
could
good.
be increase or decrease.
Yes. So you see, it's a very simple thing, but these are the risks that the banks have to look at. Why am I saying that? Because you have a mismatch between your assets and liabilities. Your NII, if you look at your income, you might say, oh, my NII has increased. I've got 0.2% because I got this deposit, I got 5 years. So for that particular year, you're showing a very healthy NII. We'll just assume it's healthy for whatever reason. However, 1 year of healthy NII doesn't mean that's going to continue for the next year and the next year. That's why it's important to look at the composition of assets and liabilities to understand whether, what I told you at the beginning, whether the bank can sustain that same level of profitability, i.e. in this case NII, over the period of time. Because like in this case, come the next year, if interest rates have gone to 4%, then what happens to the bank? Now he has lent 3.2% 5 years. Next year, the interest rates go up to 4%. Then what happens?
Bank also has to borrow at the rate of 4%.
Okay. And then what happens
Because,
to his NII?
That will reduce your NII. Margin could be negative.
Exactly. On this particular deposit, maybe at a portfolio level, the bank will be okay. But on this particular deposit, it will be negative. Therefore, that is one of the reasons that a lot of firms like to do things on a floating basis. They borrow floating, they lend floating, so that the interest risk passes on the same basis as the borrowings and lendings basically follow the same trend. You don't leave room for mismatches. However, the risk-taking appetite of the bank, the view on the interest rates, just go back a bit here, right? Your risk willingness to take risks, this part, and your outlook on interest rates, right? Two parts of what we spoke about will also then tell you, okay, is this a good time for me to fix a lending to a client? Because I feel interest rates are going to come down further. So I'm going to fix at 3.2 because I feel next year rates are going to be 2%. And I'm not going to borrow for 5 years. I'm going to borrow for 1 year. I'm going to take a deposit for 1 year. So that view And that ability comes from you sitting down, understanding the market, understanding your balance sheet, and then deciding and your risk appetite and taking that decision. So yes, you have 1 year positive NII. So the next question is what we've just spoken about. What are the risks? So we have one risk which we identify: interest rates going up. What's the next? What's another risk that you can think about? So we have said if the interest rates go up, you have a risk that you will lose money. You won't have that income next year or year beyond that. What's the next risk, or what's another risk? Just think very simply. Don't overthink it. If you are now, you have lent money at 3.2. You know, one risk is next year I have to borrow that money. I might have to borrow it at 4%. So that's a risk. What's the other risk you have?
Defaulting risk of the
Okay, let's not talk about credit risk here. Okay. Let's not leave credit risk out of it. When you lend for 5 years, you always have a risk that the guy might not give the money back to you, right? So that's a different risk. But forgetting credit risk, forgetting default risk, from a purely asset liability perspective, from a market perspective, what are the other risks you have? So, for example, next year, when you go to borrow the 100 million, right, to plug in the gap in your balance sheet, you can't borrow it because there is no liquidity in the market. Because say like this pandemic, for example, something like the pandemic happens, and then getting money in, especially US dollars, is a really difficult situation to be in. So which basically means even if you're willing to take a hit, you're willing to take a negative interest rate for a short period of time because you need to make sure your balance sheet is, how can I say, balance sheet is healthy and stays, you stay within your parameters, you can't. Then there's nobody to lend you money. Could be because your own credit quality has dropped and nobody's willing to give. It could be a country situation, could be a market situation. The fact that you will not be able to access the liquidity in the first place, whatever the cost. And that can happen. That's the risk you have. So by borrowing short term and lending long term, in this case especially, you run the risk of not being able to fund yourself over the next few years. Or even if interest rates are low, say even interest rates are still 3%, for some reason that the funding might be at a premium to you. That can happen as well. Is that clear?
Yes, sir.
Okay. So those are the main risks that are there in that particular example. But it is not that this is a wrong decision. It has to be a calculated decision made by whoever is managing those funds, and on what basis they've done it. And of course, this says it's a compounding interest rate. So you got to make a calculation to see whether this 3% compounded over a period and how this lending is. So obviously, if it's interest at maturity or interest per annum, etc., those calculations and mathematical decisions have to be taken as well. That's a given. I'm not going to go into that. But those are things that, as a basic level, you should. For example, you can't be borrowing money at paying interest per annum and then charging the guy at maturity. There's going to be a difference in interest rates because of the compounding effect. So that has to be known as well. Okay, so ALM is concerned with strategic balance sheet management. We've already touched on that, and like we've just said, what is market risk? So like I said earlier, we are not talking about credit risk here. We're mainly talking about risks that come from the market. There are different types of risks the bank has to look at: operational risk, credit risk, financial crime risk, various kinds of risk that they have. And market risk is one of them. So when you say market, what is the market? Market has various kinds of markets. You have the interest rate market, you have the foreign exchange market, you have the stock market, you have commodity prices. In the case of banks, the main risk that the bank has to worry about, the most predominant two risks are interest rate and foreign exchange rates. Of course, there are banks that basically deal in equities. There are banks that have commodities on their books. They have those risks as well. But if you look at a majority of banks that deal in definitely in Sri Lanka, you are mainly worried about your interest rate and foreign exchange risk management. So through ALM, you basically look at the market risk part of it in order to maximize profitability, maximize NII, and maximize the also manage the risk of the bank. So slide 17, like I said, you manage the interest rate risk and the liquidity risk of the bank through ALM. So why you talk about interest rates here? Why? Because at the end of the day, you're talking about raising deposits and lending money. So at the core of it all is interest rate. Even if you use a foreign exchange product, you generate liquidity or funding from it, or you deploy your funding from it, thereby managing your interest rate risk. I'll explain that to you a little bit in detail. And you manage what we discussed when we did the treasury management piece of the course also. You manage your liquidity risk, meaning what I mentioned earlier, you manage to make sure that you remain solvent or liquid over a period of time while taking the decisions you do, so that if by any chance some of the assets you deployed or some of the liabilities you raised rather, if they come and say, look, I need my money back, you have sufficient liquidity at hand to give that. Because ultimately, remember, a deposit is a demand deposit, meaning in banking, the client can come and say, look, I demand for my money back. Yes, you can charge him a penal interest rate, early take up, whatever, that's fine. But you have to give the client his money back. Yeah, which basically means that you have to have the liquidity on your books to give that money back to the client. So ALM is making sure that you make that money while making that, ensuring that you make your interest income, make your profitability while maintaining that liquidity. So we're at slide 18 now. So we need to match assets and liabilities. Yeah. So like I said earlier, if you look at this, what I mentioned about floating interest rates and fixed interest rates. If you look at the point number 2 there, what we're saying is if assets and liabilities are perfectly matched, then any volatility interest rates would have equal and offsetting impact on both sides of the balance sheet. So this only happens if you have floating interest rates. So what I'm trying to say there is, if you have an asset which is 5 years, like in the example, but a liability that is 1 year, then volatility interest rates would not have equal and offset impact on both sides, because one will be fixed, the other one will be floating. However, if both sides of the balance sheet are floating, that means that ultimately you end up with very little risk, but both sides of the balance sheet will move in the same way because of volatility in the interest rates. So that's why a decision has to be made. Like I said, when do you fix your rates? When do you leave them floating? Any questions?
No.
Okay, good. Yeah, so same thing what we are saying there, slide 19. Yeah, so basically what it's saying is what we've discussed. A decision on when to fix interest rates, when to keep it floating, will be made based on, by ALCO, based on a view on interest rates and the composition of the existing assets and liabilities on his book already, i.e. how much of assets are already fixed, how much of liabilities are already fixed, and therefore we feel interest rates are going up or down. Shall we fix more of it, or shall we just leave it floating? Those are the questions you need to ask and then decide how to, amongst other questions. But when you look at the interest rate view, that's what you got to do basically. So how does it impact? Right now, okay, if I were to ask you all a practical question, to just get away from the slides for a second. What are the current interest rates in the market? Who knows where interest rates are now? Deposit rates. If we were to go to a bank and ask, we all are working in banks, so what would your respective banks be paying for a 1-year deposit now?
Probably 7%.
7%. Anybody else? Where do you work, Rushid, again?
NDB.
NDB, right?
Yeah. Yes.
I don't think Dimanta will be happy paying 7% for a deposit, but still, okay. Anybody else?
Five, 5.5.
Yes, that's right. Okay. Anybody else? Where do you work? I'm sorry. Who is this?
Vishaga.
Vishaga. Where do you work, Vishaga?
NTB.
You also at NDB. Okay. Right. Okay.
No, Nation Trust.
NTB. Okay. Right.
Yeah.
Okay. Boya. Boya is paying 5.5%. Okay. Who else? Okay. So currently, Treasury bill rates are below 5%. I think 4.6, 4.7 rates like that. So in other words, the risk-free rate, as we call it, which is the Treasury bill rate, is trading below 5%. And you're right, there are banks who are paying 5 and as much as 7. I've heard about this. But I think most banks are paying between 4 and 5% as a 1-year rate. That's the lowest interest rate I've seen.
So currently it is 5.5.
5.5, yes, so right, okay. But
Yes.
I know certain banks are paying 4 to 5%, and you might be right, 5.5. The lower, even at 5.5, this is the lowest interest rate I've seen in our market for the last maybe I would say 7-8 years, maybe more. Yeah, the same 1-year rate was as high as I would say 14%, 13-14%, maybe a couple of years ago. So interest rates have come down dramatically in the last few years, right? So I am at HSBC. I know we were taking deposits at one time for 5 years, 3 years ago or something like that at 16 or 17%. So obviously, whether people deposited or not, if people had deposited at that time, they'll be earning a very high interest rate now for the money that they have placed, and they still have that funds in their books right now. You can't even get that now. So if the bank had made a decision looking at its composition, I'd say, okay, 16%, 17% interest rates. Oh, now what do I do? Do I go and fix interest rate set and lend at 20%? If they had borrowed at, say, 15% 3 years ago for 5 years, can I go and lend at 20% for 5 years? Chances are, even if the firm wanted to do that they can't do it because there wouldn't have been many people willing to borrow 5-year money fixed at 20% because it's a very high interest rate. So most people have said, okay, we need to borrow money, but we'll take it floating. So they would have probably lent at, maybe 16, 17%, whatever at that time. And people would have been borrowing it on a rolling 1-year basis or something like that over a period of time. Now, interest rates have come down. So those people who have been borrowing long-term, these clients, and banks who've been lending to them, there could be a case where the customers come to the bank and say, look, okay, now I want to fix my rate for 5 years. Can you give me a fixed rate? Right now, the bank has to make a decision on how they will definitely have to give that customer a rate, fixed rate, because if it's a product they're giving, they have to price it and give the client. but how competitive they are on their pricing or their ability to even offer the product, we'll say for that matter, will depend on their, one is on their view on interest rates, etc., but also the composition of currently of their assets on liabilities on their book. If they have a whole lot of liabilities that are at that 15% interest rate, then till those liabilities drop off, they will find it difficult to give a very competitive rate on the assets that they raise as well. Because why? Because they have not really managed that out by giving fixed term loans. They have these assets that are still paying high rates, or they have to take a call. No, it doesn't matter. Interest rates are probably going to go down even further. Let's deploy this money now at say 6%, 7%, 8% fixed for 5 years. And on the way down from a portfolio level, on average, we will still, it will be a good decision we made because rates might go down to 3%, for example. So this is a good opportunity for us to fix down the new assets, the liabilities that we raise, right? And not deploy and wait for the other portfolio to run down. Right? So it's a dynamic process, like we said earlier. So all depends on where rates are and also what your composition, what your assets are, and what your view on rates are. So this decision-making process is all part of the bank's ALCO team. Yeah, and their assessment of the future state of affairs. Is that clear?
Yes, sir.
Thank you. So now we boil down into Treasury. Now, Treasury basically, before that, I must tell you how it works in the structure. I think we mentioned this when we did the Treasury management a bit as well, but I'll just refresh that. So when you look at a typical global markets and Treasury theme, there are two parts to it. There's what we call the global markets bit or the markets bit, and there's what we call the Treasury bit. The markets bit is the trading and sales arm of a global Treasury of a global markets and Treasury operation. Basically, what it means is it's a component that looks at client level risk in terms of interest rates and foreign exchange, and also the bank's trading arm, meaning how does it use its foreign exchange assets and liabilities to trade and make income for the bank. The Treasury role is basically sits with asset and liability management. In other words, it looks at the bank's own balance sheet, yeah, and decides how we can deploy that balance sheet in the most efficient manner for the bank itself and obviously for its clients. But it does not face the clients, right? So the trading desk would face a sales desk who would then face clients, and they will manage clients' risk and their own risk in that way. But the Treasury desk will not face clients at all, or the sales desk. They just manage the bank's balance sheet in a most efficient manner based on the assets and liabilities created by the sales and trading activities and the bank's overall other businesses, the activities they have. However, Treasury sits within the global markets and Treasury environment. Why is that? It should be, for example, some people can argue that it should sit within the corporate finance or finance department of a bank, or even corporate banking of a bank. But why does it sit within the Treasury? Why does it sit in the Treasury and global? If it's looking at the balance sheet and how efficiently managed, shouldn't it be in finance, for example? Why is it sitting in the markets business?
Treasury could have the understanding of the market behavior.
Yes, very
other
good.
Than finance.
Very good, very good. Because remember, ALM is a lot to do with understanding the market. As much as there is, and also not only understanding the market, using market-related products to deploy or raise funds. So, for example, every single day, the Treasury guys the balance sheet guys would look at the bank's funding situation and decide whether we have a surplus or negative funding. And based on statutory reserve requirements, based on other regulatory requirements, liquidity ratios, etc., decide on how to manage that risk. Where do I get money from? And sometimes, for example, we are short, say, 100 million, say 1 billion rupees, and it's a SRR balancing day. You need to borrow that money. You're not going to go up and get a customer to give you 1 billion rupees overnight. You need to then find that money from somewhere. Where do you find the money from? You go out in the money market and you borrow that money, or you go to central bank and say, look, I'll give you treasury bills. Please give me 1 billion rupees. Fine, that's done. Now, you can't sit in finance and do that. And then what period do you borrow that money for? You want to just borrow it overnight because it's just 1 day requirement, or you think this is going to be a more systemic issue, or there's going to be a longer term requirement for you, you borrow for a month or 2 months or 3 months or longer. That decision sits with Treasury because based on the understanding of the market, how is the liquidity situation? What are interest rates doing? Who is lending? Who is borrowing? What is my balance sheet? What is my cash flow requirements for the next 1 week or 2 weeks? All that feeds into Treasury. So why there are sudden requirements like that? Because like I said earlier, what you have in your deposit accounts with customers can be taken out tomorrow. Customer does not have to give you a reason why you're taking the money out. I mean, except for financial crime and all, you might ask the reason, but in essence, they can say, today tomorrow I have a payment, I have to make the payment now. Please transfer that money to this X place. And you need to send it out. So that bit of discussion on how you manage that is with the Treasury, and for them to do it in the most efficient way, they have to understand the market conditions. That's why the ALM risk is within Treasury and it's managed in that way. So, like I said earlier, the ALM risk will basically manage the liquidity, capital requirements, gap positions, rate sensitive assets, and basically when you say competitor analysis, it will take into account the view on interest rates taken by and what other banks are taking, pay on deposits, etc., and then just its own ability to take interest rates, take the liabilities and deploy assets based on that basis. So the Treasury part of the MI, this market MI comes to ALCO from Treasury, basically from the balance sheet desk. So the Treasury function sits in the front office. They work very closely with the middle office and the finance team to get the MI required to manage this portfolio. So what do I mean by MI? So if you are sitting in Treasury today in the front office of a Treasury dealing room and you want to know how to manage your balance sheet, what is the MI you require? You are given the ALM desk tomorrow and said, okay, manage the ALM desk, here you go, start in the morning. What is the MI you require from the middle office and the finance team? What kind of information do you require? Very basic. What are the information? If you go and have to manage a balance sheet tomorrow, what is the information you require?
Cash inflows, outflows.
Very good. Yes, you need to know what the cash inflows, outflows for today is, and maybe for the week or whatever. If it's a reserve week, what that requirement for the reserve week. What else do you need to know?
The maturities, borrowing maturities, lendings, FDs.
That's right. Very good. Yes, your current profile of your assets and liabilities, basically. Yes, correct. And then also your ratios. How is your liquidity ratio? Are you within your current liquidity? So there are day-to-day activities you manage as a treasury, and there are longer-term, monthly, quarterly, annual ratios that you have to maintain. So you need to work very closely with your finance guys and your middle office to get that information. That's what it refers in point 2. Because yes, you can deploy, but you can only deploy and generate and do whatever you're doing with the correct MI. Because you don't have line of sight of that MI. Finance and middle office are the guys who will have that information and say, okay, this is your cash situation today. Yeah, this is your interest rate thing today, right? This is the amount of surplus we have, commercial surplus we have to deploy. Then the treasury guy will think, balance sheet guys, okay, I have seem to be having like ₹1 billion every day for the next month. And my corporate banking team has not been able to lend this money out to my clients, right? I will lend this to, I will buy treasury bills with this because I think that's the most efficient thing to do. Even then, even if the corporate banking guys say, no, I have a client who wants to borrow money from me for a month, I can lend it to him with a 2% margin. The treasury guy can say, look, what are you lending at? He said, 7%. Say, no, I can buy a treasury bill at 6.5%. Corporate banking guy say, no, but 7 is better than 6.5. Why would you want to lend at 6.5 for a treasury bill? Treasury guy's argument could be, look, from a capital efficiency and a risk reward perspective, the treasury bill is risk free and gives a higher rate of return on risk than a corporate client who has a very high risk rating, and you have a higher risk. Therefore, your return on risk is lower for that client than it is for a treasury bill. So it's better for us to deploy that money at a 6.5% treasury bill rather than 7% to a client. So that decision can be argued or debated and looked at the ALCO level, and not necessarily everything is done at ALCO, it's done at transaction level, but ALCO can sort of ratify the decision process to say this is what we are doing as a strategy. Is that clear? Okay, so basically the slide 21, we are talking about financial risk. So basically it's all part of ALM and it's reiterating what we've discussed just now. Volatility of asset prices and liability clearly affects financial plans. So basically this we are talking from a more overall perspective. Okay, before we go in there on specifically on ALM, on the role of ALM, any other questions, please? If not, what I plan to do is we can go into this area and we will look to take a break at 10 o'clock, which is 20 minutes from now. Is that okay with you guys? Okay. Right.
Okay.
Let me just start on this. Yeah. Okay. Thanks, Rusha. So basically, financial risk. So basically, as you know, if you hold on to any asset or any liability, the movement in that asset price can lead to affect your financial plans. So for example, forget about the bank and forget about ALM for a second. If you own on to an asset, could be a car, could be a house, could be anything, could be gold, could be any sort of asset. The price of that, the volatility of price of that will affect the your financial plan. So if I give you an example, if you had bought a gold chain last year, I think the sovereign was about 70,000 rupees a sovereign. Does anybody know what a sovereign is today? Price of a gold sovereign. Any ladies there who want to buy chains? I'm sure they know. Huh?
Close to 100,000.
Sorry? Go ahead, Ruchira. You were saying something.
Uh, 100,000. Like,
yeah, it's about 95, but close to 100. So if your sovereign was 75,000, in the last 6 months because of it has basically gone up to 25,000. It's going up because one is because of there is these restrictions in imports, and the other one is because gold prices anyway overseas also has picked up. Yeah. So put them both together. What has happened to your asset price? It has picked up. Now, does that have a effect on how you plan for the future? Now, if you are looking to sell that, today you can sell that, make 25,000 rupees profit, and then that means your financial plans might be slightly different. Now, you take that money and do something more than you earlier could have done because you made money on this basically. So basically, what I'm trying to demonstrate is a value of the asset you have, whatever that asset is, change in the prices on that asset and liability affects how you plan for the future. If it is making you more money, you might want to basically keep that and use that funding for other purposes if it has appreciated in value. If it has depreciated in value, then you might think twice before you put your money into something more riskier game. You might be a bit more conservative in your decisions. Yeah. So that risk that you have, that financial risk, because there is never a right answer. It's a calculated decision you make. That financial risk that you have is always there. The risk of financial loss, financial risk, or financially making a profit is always there. So you need to manage that financial risk. So what impacts that financial risk? So for example, there are various things that come into incorporating into that risk. So let me give you a few examples. What is market risk? Now we've discussed it at length. What is market risk? What is market risk?
That is change. That is change in
Yes, say.
risk of change in market interest rate and liquidity.
Okay, so market risk is a price of an asset changing because of market change. So forget about interest rates, foreign exchange, everything. Anything has a market, right? So you have interest rate market, you have a foreign exchange market, you have a commodity market, you have a credit market, you have all kinds of markets. So basically, anything that is traded on a market, if that market price of that changes due to demand, supply, whatever the reason, the value of that asset, like I mentioned about gold, the value of that asset can change. So that's a risk you have. Good or bad, that's a risk you have. That's market risk. That's what, from a global markets, why global markets and Treasury sit together is to manage that market risk. It's risk management for markets, basically, on an active basis. What is credit risk? Correct. You give somebody a loan, we say, and they don't want to pay it back. That's a calculated risk. It is always there. You have to make that decision based on your best efforts. What is liquidity risk? We discussed it today also a bit.
Risk of not able to pay. Risk of not able to pay for payment on obligation on time. Not able to pay obligation on time.
That's from your side, but what's the liquidity risk if you have? Yes, you're right. What's the liquidity risk you have? Or rather, bank has.
Cannot.
Yes, cannot. Go ahead.
Cannot meet the obligations, like it could be short term on time, short term debt on time, like.
Correct.
Once customers request their deposits and all, we couldn't pay back. Very
good. But why would you not be able to do that? So you can't pay your depositors on time. Very 100% correct. That's a liquid risk because of liquidity.
Since you don't have money,
Why don't you have money? Why would you
since
not
you
have?
don't have, since don't have, because we don't have money, since we might lend it long term.
Okay,
Could,
that could be the case, but why? Okay, you have lent long term now. You don't have money now, but why can't you raise money? You have lent long term, correct? Why can't you raise the money to give the?
One could be the our this credit worthiness might have lost. Otherwise, in the market, you don't get liquidity in the market. Like even though you need the cash, you won't be able to get back.
Right, correct, 100% right. So basically, yeah, you're 100% correct. So basically, so one aspect of what you said is partly credit risk also, that your credit quality has come down. But yes, liquidity risk comes from the fact that you might not be able to raise funding when you need it to meet your own depositors or whoever's obligation. So you run the risk that the liquidity in the market, either due to, going back to the first point, market conditions themselves, or your own unique situation that you are not able to raise liquidity. That comes from your quality of your assets and liability, a piece of people's perception of who you are as well. So it's a mix between credit, market, everything, but the fact that you will not be able to raise the liquidity. Or it could be your credit is perfect, the market is perfect, but for some reason, there is no liquidity in that particular currency. For example, in Sri Lanka, we have an issue in dollar liquidity. We have plenty of rupees, but dollar liquidity is not easy. So if there is a dollar client who has dollar deposits, comes to you and say, I want to take my deposit out, there could be a bank which says, look, I have an issue, I don't have dollars right now. So you have a liquidity risk in that currency. It's nothing to do with the market, nothing to do with, but it's that unique bank's ability to raise funding in that particular currency. Yeah. What is operational risk? What is operational risk?
Arising from people, process, system, and
okay, that's the definition, correct? But what do you mean?
Arising from people, process, system, and controls. Like.
Okay, so what is that? What can, how? If I ask you, give me an example of operational risk event.
One could be due to the fraudulent activity by a particular staff member, like bank could lose money.
Okay.
That's some sort of a breach of control.
Very good. Yes, that's exactly correct. So, for example, as simple as somebody putting a buy transaction as a sell transaction, putting the wrong number when the
bank front office system doesn't work properly.
Yes. Yeah, exactly. So what happens there is those are not, maybe sometime it could be an intentional thing. It could be most times it's negligence and human error. But it does mean that there is, say, for example, a client bank staff member without putting, say, $10,000 keys in a transaction for $100,000. The next day, when the bank realizes that there has been a error, they have to reverse the $90,000 that are excess, basically. And then the exchange rate on that day could have changed. If the exchange rate has changed, that means the bank has a real risk because it has to go into the market to unwind that unwanted position. When they do that, there is operational risk, there is a financial loss, financial risk, financial loss, and that is coming because of operational risk, not because of a credit decision or the market, changing, and therefore that asset changing. It's coming because of an operational event and having to go through another transaction on a day that things have changed later, and that's operational risk based. Or it could be, like I said earlier, somebody processing a transaction, sending it to a different country. Instead of sending it to the US, sending it to the UK. So the money coming back, that goes in the wrong currency, wrong place, 2-3 months later you get it back. So there are various situations like that. And it's a common thing, like you said, because most of it is due to human error. So that's a operational risk is a very, very prevalent thing in every company. Legal risk. What's legal risk? What is legal risk? Okay, so I was told by my bank lawyer recently that litigation is not legal risk, meaning going to court with a client because he's defaulting or whatever is not legal. Sorry? Sorry? I'm sorry, I didn't hear you. Sorry, hello, can you hear me? Hello? Okay, so legal risk is basically litigation going to court is not legal risk. Legal risk is you going to court with a client.
We can hear you, sir.
Yeah, okay. Legal risk is you going to court with a client for a transaction where, for example, the client has defaulted on a transaction, credit loss, whatever, and not having the proper documentation and proper sound procedure in place. So, for example, you have not taken a credit document from him duly authorized by his, signatories or something, or that you have not got a board resolution for certain transactions, or in some cases there could be like master agreements that need to be signed. You have not signed those master agreements. That is then when you go into a court case with a client to recover your losses, you are then on a bad legal footing. That means you have not covered the legal aspect of it. Going to court itself is not a legal risk. It is the process and how comfortable your legal team is with the documentation and everything that you have. And that is why most often you have to go to your legal team when you go for this to make sure your set of documentation is sound. And they have to sign off on most of the docs you do, especially if it's a unique thing that you're going ahead with. And the last one, country systemic or political risk. So basically, it is what it mentions here. So, for example, the risk you have because of a change in the governing party, the president, the parliament changes, where there's, all, for example, what we see in Sri Lanka, for example, changes over time. Not necessarily because of any sort of political affiliation you might have, but more to do with the policy changes that come with it. For example, what I meant in terms of interest rates. Will a change in government in some country mean a shift in policy from a low interest rate environment to a high interest rate? Monetary policy changes basically. What is their view on how to run the economy? Those changes, those views will have an impact on how you look at your balance sheet and how you look at financial risk and how you manage it down. So that's also very, very important. This is not only to do with Sri Lanka. You must also look at it from a from a global perspective. So, for example, if you look at the US, if you're looking at funding your customers in US dollars, and now in the US dollars, there's historic low interest rates again. In the last 10 years, we've had it twice now for different reasons, but twice. Is that the view that, for example, if Donald Trump is not there in the end of this year, will that be the same view that is taken by a Democratic government next year in the US? Will that change? How long will the US Federal Reserve keep its interest rates as current level? Because that has an impact on where you're funding your dollar as a where you are raising your dollar liabilities at, and therefore what you can price your assets at in that currency. So, and then any political change there, how does it impact their relations with, say, for example, the US relations with China? If there is a change there, how will it impact the exchange rate in the US dollars? So more and more, because we are a connected world, we cannot only look at our own country and say, okay, this is where it is. You have to look at it from a more global, because it is also impacting your clients. If it impacts your clients, then it's going to impact you, and then therefore it's going to impact your ability to manage your own balance sheet. So this country systemic or political is not only about Sri Lanka in this case, but your specific country. It's about the global environment and how connected you are as well. So all those factors, there's one more here, financial crime risk, which is not here. But for example, if you have a client who has been depositing money with you and who is later found to have been raising that funds from illegal sources, you have the risk of sanctions, censure, litigation, penalties from the regulator, whatever, because of that risk as well. And that's going to cost you ultimately. If it costs you, it costs your shareholders basically. So financial crime risk also is another component. It's not mentioned here. That is very much something that is looked at as well. Yeah, so all these things get together to form how you would look at overview of or overall of financial risk basically. Any questions, please?
So can you explain the legal risk?
The legal risk, okay, yeah, sure, no problem. So for example, we'll say what's your name, please?
Videsh, sir. Videsh.
Videsh. So Videsh, you say you are working in the credit department and you lend a client money. You go out and you say the client comes and says, I want to borrow 10 million rupees. You lend the guy 10 million rupees. What are the documents you will get signed for him? If you are lending a client 10 million rupees or whatever, you will have a set of documents you'll give him, right?
Yes.
There will be a application form. There will be certain things that you have to fill out. Depending on how the company is structured, they might have to pass a board resolution and say, okay, fine, here you go, and then they'll have to give you collateral sometimes if you want some sort of collateral for them for security. All those will mean legal documents, mortgages to be assigned to the bank, all kinds of stuff, right? So the mortgages, the legal documents, everything comes, and then you have a full set of documents. And then you lend the guy the money. Come, 5 years from now, he says, look, I can't pay you the cash back. So what do you need to do? You have to go and you have a case. You have a legal case, whether you call it parat execution or whatever it is, depending on situation. You have to go to court and say, look, my client is not paying money back. I am calling on my rights based on the set of documentation I have and the laws of the country, the Banking Act or whatever that might be. Based on the laws, I'm calling on, and I'm going to basically, but ultimately you do have to go to court to manage. Is that understood? To get that money back.
Yes, sir.
Unless you arrive at an agreement outside of court. So now that is not a legal risk. Legal risk because that is the way banking is done, and the laws of the country allow you to do that. However, when you go to court, if you find that you have not assigned the mortgage properly, for some reason you have not assigned the mortgage, or you have not taken a board resolution from the client where you should have, or you have not signed another document that you should have, saying that, look, this is the basis on which this collateral was given. Yeah, that is a legal risk, meaning that your legal process has not been sound around it, that you have missed out on your list. So that is one of the reasons when, depending on the value of a transaction and the importance of it, usually the bank's legal team has a look at it and says, okay, this looks okay. We've got everything in place before they go ahead. So the legal risk is not the litigation. Legal risk is not going to court, and going to court is a normal thing. Legal risk is not having the correct documentation and following the correct legal process to do that. Is it understood?
Yes, got it.
Any other questions? Okay, I'll stop there for the moment. So I'm stopping at slide 22. That's the last one. And we start off on 23. Take a break. It's 10 o'clock now, a little after 10. We'll target to start in about 10:15 to 10:20, if you don't mind. Right, okay, so basically, we discussed financial risk. What is financial risk? We had an overview of ALM and what ALM is and how ALM is important to the bank, asset and liability management in terms of managing the bank's financial risk and also maximizing profitability for the bank. And also we discuss what Treasury's role in the ALM process is and what the role of ALCO is as well, in brief. Now we are going in to go a little more in depth into that and are trying to understand basically how ALM fits into the organization. Basically, we are looking at ALM in ALCO, through ALCO, and what the primary sort of responsibilities of ALCO is in terms of managing the ALM risk or the balance sheet risk of the bank. So ALCO, like I said, is Asset Liability Committee. It comprises of few key stakeholders. It will have the business heads, so it will have the head of the branches or retail banking or personal banking, as different banks call it different names. It will have the head of the corporate banking. It will have the chief financial officer of the bank. It will have the CEO of the bank. It will have the treasurer of the bank, and it will have the chief risk officer of the bank as well, sitting in there, basically, and they'll all sit together. It will not have, obviously, this is looking at the balance sheet, so you don't need to have people like HR or marketing or, those people are not necessary for that particular function. This is purely looking at the bank's balance sheet and the risks they are on the balance sheet and how you manage those risks. So from a treasury perspective, from a global markets and treasury perspective, the treasurer will sit in there, and depending on how the bank, how relevant it is, we will have the head of the treasury balance sheet desk or the ALM desk also sitting in at ALCO. Frequency of meetings depends on the company itself, but you could have one every 2 weeks, or most likely, I think every 2 weeks is the usual frequency. You could even have a weekly meeting. That's possible, but what I find most organizations could maybe doing is they have a 2-weekly meeting which is quite in depth, and a once-a-week meeting that is like sort of a very high level refresher sort of on the main action points that are there. But every 2 weeks they could have a very much more in-depth discussion into the whole situation as it is. So during an ALCO meeting, the key points of this would be, obviously, any other meeting that you have, you will minute it and you will have action points. And each person, there will be a responsible person who has to basically deliver on that. So this is stating the obvious in this particular slide, but what it's trying to say is, look, like any other meeting, you have to have a structured method of making sure that the meeting actions are delivered, and then going ahead and ensuring that those are implemented. So the terms of reference has to say what the scope of the meetings are, and then basically based on that, or the meeting secretary, who is usually the CFO or the finance guy from finance, would look at that and say, okay, fine. These are the main actions we have before next week, the meeting in the next month, the next 3 months, and these are the people who are supposed to deliver on them. So looking at the terms of reference and looking at the deliverables of ALCO, if you look at it, these are some of the areas that should be considered. Like we said, they rely a lot on reports on what the current liquidity situation is, what the current market situation is, and what the current capital situation is. From those kinds of reports, they will identify what are the gaps in the balance sheet. Is there an interest rate mismatch? Is there a profile mismatch? Right? And that could lead to issues in the future, lead to underperformance. It could be to risk to the organization, all that. Yeah. Then the deposit pricing strategy. This is why the heads of the department. So somebody could say, look, why does the head of corporate banking or the head of finance, personal banking have to be in ALCO? Why can't it just be, the treasury guy and the finance guy? They'll know the market, they'll know the balance sheet. They can decide on, how to deploy the money that is there, how to raise assets, and just tell the guys, look, go ahead and do this. Because I might say, if I'm a treasury guy or I'm a finance guy, look, you're pricing your deposits too high. We can't afford to bring deposits in at 8% anymore because our assets are at 6%. So we are losing money when you bring at 8. Don't put your deposits at 8%. Put your deposits down to 5%. But the guy in the branches, head of the branches or head of personal banking or retail bank, he might turn around and say, look, if I bring my deposit rate from 8% to 5%, we are going to lose all the deposits we have right now. Nobody's going to bring money into the bank because this is where what our competitors are paying. Our competitors are paying more than this. If we are to retain, we have to basically pay this rate. Or they have to say, look, we are trying to give a value addition to this. Like, you can give insurance, you can give credit card promotions, all this other stuff. And therefore, we may be able to reduce it by 1%, but we can't bring it down to 5%. Then the ALCO has to decide, okay, what is the risk if we bring the interest rates down and we lose money? Where are we going to fund this attrition fund? Where is the funding going to come from? Where is the funding? Can we raise it in the money market? Is it short-term funds? Is it long-term funds? Are we happy to lose these deposits? But the business case of the person who's raising the deposit has to be made at ALCO to say, no, I need to pay this rate because of these reasons. Yeah. Same with the asset side. If the head of corporate banking says, look, I need to lend money at 9% to my corporates, and the guys in ALCO said, look, why are you lending at your returns are very low? You should raise it to 10%. You should raise it to 11%. But he might turn around and say, no, look, if I raise it to 10 and 11, people are not going to borrow me because my competitor is lending at 8%. Then the guy in Treasury might say, look, you don't want to worry about lending it to your corporate. I can buy Treasury bills at a good rate for this. You don't need to worry about it. But the head of corporate banking would turn around and say, no, I need to make this client, keep this client with us because of this client's lending that we give this client. We are also getting business from our trade business. We are getting business from our cash management. We are getting all these other additional business as well. So it's not just the lending. So I'm happy to give him this large loan at this rate because I am also making money on these other components of his relationship. So it's not a straightforward decision. And if you were to just look at it, if finance, treasury, and other people were to just look at it purely from a numbers point of view, sometimes the decision could be very different to when you add in the qualitative arguments that come from the other stakeholders to that conversation. Because everybody can't see everything at the same time. And that's why you have ALCO to have those discussions and then to ratify the final decision the bank takes as a whole. And the last point there, review contingency plans. So for example, review liquidity contingencies. Now here, this is not about talking purely about liquidity risk. This is about contingency plans. Meaning, in the case of a stress situation to the bank, how comfortable are we that we have a very good contingency plan? In other words, what we discussed earlier, if there's a huge liquid risk and you can't raise money because there's a specific currency or country situation in the country where your liquidity is stressed out, do we have a quality of assets that we can liquidate to get our liquidity back in order? Do we have other sources of funding that we can call on to offshore funding or whatever it might be to mitigate that liquidity risk that we have? that contingency plan has to be drawn out by finance, by treasury, and given by ALCO overall. So this is our liquidity contingency plan. And this is still relevant today. It's changing now. It should be like this, like this. That whole thing also has to be reviewed and tabled at ALCO and reviewed periodically to see whether it is still relevant. Okay, any questions, please? Any questions? Is that clear? Okay, so I'll go to the next slide, 26. That's what we did, sorry, 27. So basically, like I said, risk management. What is the scope? Now we discuss what kind of information they have, what they look at. So the broad scope, one of the broad scope is risk management. Managing the risk that you have at a point in time and making basically a decision based on a risk assessment that you have made. So basically making sure you have the right mix of assets and liabilities, taking into account all kinds of scenarios that you might have while managing risk to you optimize profitability at the same time for the organization. So asset and liability management, like I said at the beginning, now we are not talking about ALCO here. We are talking about within ALCO managing your assets and liabilities, right? As a function of ALCO. So it's not just about managing risk or making sure the bank is healthy. It is about using it as a management tool to enhance profitability for the companies. Like I said earlier, even in the treasury management bit, if you all remember, treasury management is not just about risk management for the sake of risk management. It's not only about safety. It's a concept of making sure you have the healthiest possible return for the equity and the capital that you have, and take into consideration the various scenarios that you have to face in the future. So it's making sure you have a very good return on your equity that you have got. So at the end of the day, it's broader than just managing assets to liability. It is planning and managing the balance sheet for the optimum point for the return for your shareholders and your depositors. So the concept of planning has three broad areas. One is, like I said, equity management, making sure your equity is at optimum, return on equity is optimum through ALM, right? Second one is risk-adjusted spread management. So basically, it feeds into profitability and equity, but it also is telling you, look, I want to make sure that I make the best return I can with the lowest possible risk, and therefore the best spread I can, NII, at the lowest possible risk. And the third one is burden management, meaning basically all my, if you take all the stresses you have, debt burdens and all this stuff, to manage them in the best possible way. So through your management, what are you trying to do? You're trying to give the best return to your equity holders. You're trying to break the best margin possible at the proper risk level. And you're trying to manage the stresses and the issues that you will come up in the future. So through ALM, through that, looking at those asset and liability mix, you're trying to achieve all those things. Return, risk management, and reducing the issues that you can have in the future. Take all that into account. What are you trying to get at here? Like I said, you're looking at the optimum possible return on equity. In other words, the level of profit you can make for your shareholder, basically, based on the bank's business model. Basically. So the optimum level of equity, return on equity, that you can provide to your shareholders based on your business plan and processes that you have. All boils down to that, because ultimately the shareholders are the ones who own the firm. They are the ones who say, look, I am going to stay with your firm as long as I get a return of equity of X amount. If you are not meeting that ROE targets, then I am not happy to keep my money with you in the future. So I'm going to buy something else, not you. Your equity holders leave you. You have to substitute that with debt capital. The more debt capital you put in, more leverage comes in. The higher could be your cost on those things on one side, and those are not long-term funding. Those could be very short-term liabilities that you raise, which are not really healthy for the organization. So you have to have the correct mix, and you have to have investor confidence. So little bit more return on equity. If you look at the calculation, it's basically a profit margin, your asset utilization factor, and your equity multiplier. So basically, asset utilization means how much of your assets, how much of, okay, profit margin is profit margin. How much of profit are you making, net profit you're making after all your costs are taken into account, etc., etc. That's straightforward. Asset utilization factor is how much of return are you making for the assets that you have basically deployed. Yeah. So in other words, you have deployed, say, 100 million rupees worth of assets. Your return is, say, 50 million rupees. What's your asset utilization? 0.05%. So in other words, you're making 50 million for 100 million deployed. Yeah. And then your equity multiplier. Again, if you take your assets, say you have 100 million worth of assets, and your equity is, say, 50 million, your equity multiplier is 2. In other words, for your equity that you have, how much of assets have you got in place for that? Put all that aside, what it's showing you is, based on the profit you make and the assets you have generated and the equity you have raised, this is your return on equity. So what it's trying to show is, for a certain amount of equity, the profitability that you're generating is by by putting out so much of assets. It is coming in at 5%, 6%, 7%, whatever that price thing is. That is sufficient or not sufficient. So for example, if your return of equity is, say, 7% or 8%, what are you saying? You are saying for each shareholder dollar I have given, through my business activities, I have generated a 7% return for my shareholders. Shareholders could look at that and say, okay, return of equity is 7%. Is that good for me? Should I look at, is that sufficient for me? Am I happy? Is this company making a return that is healthy for me? Obviously, they will be looking at it from a point of view is, yes, they have made 7%. How much of dividend are they going to give me? Based on the ROE, the analyst might look at it and say, okay, the company has made a 7% ROE, the share price can go up. So then the shareholder will get benefit in terms of capital gains. So either way, the shareholder has to see, one, is the return on equity good? Two, is that translating into a higher dividend payout for me, or am I seeing a appreciation in the capital of that, or the value of the share? So therefore, should I keep my money in this or not? Or should I just take my money out? That is why the ROE is important. Any questions before I move on? Please ask if that's not clear. Okay, so now we are trying to understand why ROE is important from a ALM perspective. Yeah, why is it important? Remember, we spoke of NII, net interest margin. Basically, NII is to see whether you have deployed your funds in the optimum way, based on your, basically you utilize your funds in the most optimum way, deposits against assets. So when you look at the profit margin, for you to make a healthier profit margin, one of the factors you have to have done is that you can't raise deposits at 10% and lend at somebody at 11% and keep a 1% margin and expect that to be profitable, because at the end of the day, the profit that you make, 1%, has to go towards paying people's salaries, had to go towards managing your overheads, has to go towards managing all the other administration and other costs that you might have. So maybe 1% is not enough from an overall portfolio perspective. So your profit margin, and then at the same time, so you need to look to see how you can increase that margin. And to do that, one is to make sure that you charge the correct margin. The other one is to make sure your operations overall are minimum. Remember the financial risk we discussed, that your operational risk is less, that your operational costs are less, that your overall, you manage your overall, efficiency in terms of how your processes work. Yeah, you put more emphasis on making things, streamlining things rather than, and digitizing things rather than, say, for example, have manual processes. All that feeds into cost reduction, which feeds into profit margins. Which then again, as much as you allocate your assets in an efficient way, those also come into the profit margin equation. But efficient asset allocation is one of the key components for that as well, as well as generating your liabilities at the most healthiest rates. So then you have the second point for that is the asset utilization. That again, we look at how the quality of the assets that you have deployed your funds to and the pricing of those assets, while taking into account obviously the risk. So the quality of the assets. So for example, if you buy a treasury bill, it's high quality assets because it's and less risk, but you might get 24% for it. But you put it in a corporate debt instrument, which is a lower rated one, you can get 6% for it. Now, is that quality? Not as good as the treasury bill. Is it interest rate wise? Then of course you get 2% more. But is it a risk wise? How is it? No, because the quality is not the greatest. You are taking a higher risk. Now, based on that, you might get a higher return, but how much of those assets have you deployed is of a good quality. So the asset utilization factor we look at what is the quality and quantity of your assets that you have deployed, and what are the risks associated with it. Not purely a profit margin, as the first point would have looked at. Sorry. Equity multiplier. Okay, so that concept is about financial leverage. In other words, what it's saying is you've taken money from your equity holders of 50 million, but you've deployed 100 million. So where is the extra 50 million coming from? Extra 50 million is coming from your depositors, it's coming from your activities in the borrowing from non-bank financial institutions, etc., etc. Nothing wrong in that. But if your equity is say 10 million and you've lent out assets of 100 million, that means a good portion of your assets is being funded by not shareholders. It's being funded by other means. So it basically shows that you have leverage beyond what your equity capital is. And therefore, you have a high equity multiplier. So if you make a higher return, it's good for the equity holder, because for a small amount of shares, you are making a higher return. But you're also taking a higher risk, because those, depending on the quality of the liabilities that you have raised, meaning short-term, long-term, the credit quality of the people who have given, all those factors, basically you could be at risk for a higher return. So it has a multiplier effect, because it's basically looking on return on assets in order to determine your return on equity. So in other words, what you're trying to say is, look, I'm making X amount of return on the assets for my equity holders. Therefore, their overall return on equity is based on my return on assets is X amount. But it also shows that you could be highly leveraged, which again can be seen as a good thing depending on the condition, or can be seen as a negative depending on how stressful the market is. Because usually equity holders are the last to sort of liquidate and leave the company. But your people you get funding from, corporate, whether it's by issuing corporate debt or borrowing interbank or whatever it might be, those funding is very fungible. It can change overnight. The model can change overnight. But equity holders are usually there for a longer term return. So they are ones who will buy in and stay there. So you are always looking to make sure that those return on that equity for those equities at a healthy level, and you have a correct mix of debt against equity, so that you are not over reliant on either one. Yeah. Any questions? So the last point I said there is basically what I'm reiterating on. Equity multiplier is a risk measure because it reflects how many assets can go into default before an organization is insolvent. Yeah, that's very important. Any questions? Okay. So in this case of continuing on the same subject, there are various tools that the bank will use at ALM level. I'm not going to detail, but we will look at gap analysis, duration, value at risk, simulation, stress testing, etc. to determine how do we manage the market risk, how do you manage the liquidity risk, how do you manage the overall situation in terms of whatever. So those tools are used to figure out where the risk parameters are, where the stress situations are, and then say, okay, fine, based on all this, this is the decision we make. And why do we make decision? I'm going back to this to optimize net interest income and to make sure that the return is healthy and sustainable. So there's a point on trading book management. So basically it all comes into, it's not necessarily a ALM function, but it talks about how Treasury should manage its trading book and also exchange risk at the within that. But it is more very specific global markets operation rather than a Treasury ALCO operation, although it's there. So obviously, when you look at ALM, you're looking at funding plans. So in other words, not only about the profitability, but how you may maintain your solvency and liquidity over a period of time. So you have a funding plan. So meaning not just short term, you have a long-term funding plan for the next year. Where is my funding going to come from? And where is my capital planning is going to be like basically over that period. So that you can do your business in a normal fashion and everybody else can do your business in a normal. So transfer pricing, that's a very key thing that comes into ALCO as well, ALM as well. So basically what is it saying? Like we discussed earlier, the Treasury sits in the middle. The businesses will do their business. They will lend money, they will borrow money, they will buy dollars, they will sell dollars, they will do all their market-related activity. But the Treasury sits in the middle, and the Treasury says, okay, all the risk that you have by taking deposits from interest rate risk perspective, from a funding perspective, like deploying your funding to somebody from that perspective, we will take all that together and we will centrally manage it for you. So the transfer pricing policy, what rates they buy that deposits in, what rates they will lend to corporate banking, how the foreign exchange margins that you make will be split between the departments for the various risks that they take. That whole transfer pricing mechanism sits within the ALM and basically within the Treasury, within the balance sheet management ALM division of Treasury, and it is something that will be discussed at ALCO periodically as well. And the last point there is to review performance, basically, which will happen to make sure that whatever decisions you have made, is it going in the right direction, or has it something that needs to be reviewed once more, changed once more. If you look at slide 35, again saying the same thing, it's a dynamic process of controlling based on maturities, yields, costs, etc. And then you might have an NII target of 5%, 4%, whatever. How do you get to that target? And again, saying the same thing because it's very important: profitability and liquidity. Balance sheet is targeted mix of assets and liability to earn a healthy spread as against the practice of targeting for achieving fat balance sheet. So what do you mean by fat balance sheet? Inflated balance sheets. In other words, you raise so much of assets and then you go out and raise so much of deposits and your balance sheet just doubles over a period of time, but it doesn't necessarily make you money. Or you might be creating, you might be even making a high margin, but the quality of your assets and liabilities might be very poor. So from a return perspective, you're making a high margin with a very poor quality balance sheet. So it's not healthy. So it's making healthy returns, sustainable returns is the important thing. 37, again, this is repeating what we've already discussed. So ALM and then ALCO takes a view on interest rate, exchange rate, medium long term, and then basically decides how to manage its liquidity and interest rate mismatches and maturity mismatches. Okay, so basically that is ALCO, that is ALM. So sometimes it's very easy to get the two mixed up, but what you realize is ALCO is committee, right? ALM is a process. ALM is what you do, your assets and liability management. ALCO's predominantly role is to manage that ALM process. Treasury has an ALM desk because ALM has a lot to do with market risk and market changes. So there is an ALM desk that sits within Treasury that helps in the ALM process, asset and liability process. The Treasury guys will work with the finance guys to understand that process and understand the situation, looking at the MI that they have. And then they will sit within ALCO, which has the broader business team there. And they all together will then decide based on what the Treasury ALM desk, finance guys, and overall MI that is presented to them, to what the strategy should be and basically how they should go about it. The tools to assess those strategies will be the VARs, the stress testing, simulations, whatever. Your own qualitative judgment of where the market is, what the situation is with your businesses. And then based on that, you come back and say, okay, this is the strategy we have. All done with the intention of making the maximum possible return at the healthiest possible risk factors, and at the same time making sure that the bank, the company remains safe and the funding requirements of the company are understood and maintained over a period of time. So ALCO sits there to do that. Okay, before I go on to the next one, any questions, please? Okay. You're still there, right? See, you can hear me.
Yes, sir, we can hear you.
Okay. Thank you. So we are just going on to the overall framework and where ALM sits within the overall framework of a bank. So we discussed this, I think, before as well. So there are various frameworks in the bank. There are various functions and businesses in the bank. But more than that, there are also different frameworks that the bank will work in, organization will work. So, for example, if you look at the slide 38, you see there's a regulatory compliance framework. In other words, there's a regulatory compliance section of the bank, which you say, okay, these are the regulatory requirements the bank which it has to work within. Whether it's the Banking Act, whether it's the Foreign Exchange Act, whether it's the Financial Crimes Act, whatever, there is a regulatory framework. Then there is your HR guys will have a performance management framework. This is the way you have annual appraisers. This is the way you recruit people. This is the way you have to dismiss people. This is the way you reward people. All that. Then information reporting framework. whether it's regulator or otherwise. So this is the information report. Technology, how technology is used. Operational framework will give you basically this is the operational area you're working in. This is the framework. This is how you handle issues. This is the way you process things. So on and so on. So there are various frameworks. ALM also sits within a certain framework. So this, we're just going to touch on broadly some of those frameworks that are here, and also then look at it from a more ALM perspective. So it's just giving you a broad feel of how the company works and where ALM sits within the whole, all the different frameworks that are there. Strategic framework. What is strategic framework? What it says is, what is the overall strategy of the bank? Yeah. Why is that important? Why is the overall strategy of the bank important to ALM? Why is the strategic framework given by the board of directors of the company important to the ALM judgment that people make? Okay. If the board of directors turn around and say, okay, look, we want to achieve X amount of target returns, yeah, but our risk appetite is this. We don't want to go beyond this risk appetite. We want to keep our risk within a certain threshold. We are conservative. We are high risk averse or whatever, right? And then they say, okay, we want these people or these functions to control the risk. And these are their responsibilities, right? This has to be clearly articulated so that when it comes to deciding on an NII or sort of a return parameter for the on how you deploy your assets, how you raise your liabilities, it has to be taken within the overall strategic framework of the organization. If the overall strategic framework is we need to be conservative, we can't be taking too many risks over this period of time, then you can't go out and raise deposits from highly risky sources and then lend money to highly risky sources also. Because then you're going against your overall strategic framework of the company. So it's like you are doing one thing, but the strategy of the company is sending you something else. So that has to clearly align. Those things have to clearly align. And it has to be clearly defined as to who controls that decision and risk and why you're doing what you're doing. So that is why sometimes people get frustrated with their organizations because they can't take the same amount of risk that somebody else is taking, because that guy might have a good logical reason for doing it, and you feel, look, I need to do the same thing, but my board is not allowing me to do it, or my ALCO is not allowing. It's because it could be that they're just aligning themselves to their overall strategic framework. This is the way we want to. Whether it's right or wrong, that's a decision that is there, and your thought process has to align with that. If not, then you are not doing what the company wants you to do or the board wants you to do. Yeah. Organization. So then you have the strategy, then you have the organization. So the organization framework basically says who should be in the ALM committee, for example. We are talking organization framework and how it impacts ALM. Remember that, yeah? So it will tell you who should be in the committee. What are the subcommittees you need to have, working groups you need to have, and each business line. So like I told you earlier, the framework of organization is HR is not needed for ALM. Marketing is not needed for ALM. But there could be different organizations. Say, okay, no, we need the marketing guy to sit within ALM because he has a feel of the market itself. He might be able to say how difficult it is for us to raise deposits or lend money. Yeah. In some cases, you might have the head of market sitting in on ALM, but not necessarily the individual person from the balance sheet desk sitting there in the ALM, or depends on the individual company. So The organization framework will tell you thing. Okay, look, within the organization, these are the people who are responsible to make sure the strategic framework or strategy that of the bank is met. Yeah, and then thereby get the fullest sort of support from the management. Operational framework. So basically, this is the, when you come down to the ground level, how you will execute. So in other words, you've spoken about the strategy, you know who's responsible, you know the committees, you know the organization, you know how the composition will be. But this will set out to you, okay, operationally, if we say, you know, we are going to raise deposits, this is the way the transfer pricing of it will work, this is the risk to the bank, these are the guys who will take the risk, etc. All those policies have to be very clearly articulated in a policy statement and operationally executable document. So that comes within the operational framework of the organization, and say, okay, for AML, ALM, sorry, not AML, this is how that operational guidelines will look like. This is how you will operate. This is how you will execute your strategy. Analytical framework. So now I mentioned at the time when we go into a ALCO meeting and you need to make a decision, you need to have information. You need to have your gap, VAR, all this information. Now, that is for ALM purposes, right? But you must understand, the bank does various kinds of analysis. They will look on customer satisfaction. They will look to see, for example, you know, on its foreign exchange business, how it's managing its overall risk. You know, analyze that to see whether the overall risk management strategy is the right. Or say, for example, you look at your top 20 customers and how much of return it's making on its top 20 customers vis-a-vis the other 80 who might not be getting that return, for example, you know, and decide on whether you want to keep this class. So there are various analysis happening all the time inside the bank. So there is an analytical framework. There are systems that they use for analytical framework. So from within that, the ALM function has to derive the required information they need. So in other words, they have to make sure the analytical framework, the analysis done, that the models that have been used, that they are consistent, they're timely, they are accurate, they represent what you want, they give you the MI that you really need. If you are not getting the MI that you want, then you need to figure out what other new analysis should be done. So the overall analytical framework of the organization helps you get the information to make your decisions in terms of managing your assets and liabilities. If your analysis, if you do not have the correct analysis, right, that is a risk you have, because that means you're not getting all the information that you want. Some people think that, look, over years they've got these kind of information, that's enough, I make my decision. Even me today, when I go, I find that there is certain bits of information you really need to get, that you might not be having today, and you need to go out and say, okay, look, can I get this information, please? Right? It could be something that you think of only today, but that information is important to make your decision for the future. So, for example, somebody looking back at 2020 will think, oh my gosh, you know, these risk parameters have changed so much. What happened in 2020? I'm talking 5 years from now. So that was the year that we had COVID-19. These things happened. So then the analysis may have to take that particular year out of the equation. It could be looked at as outlier, not a normal course of business. So that has to be, you have to be able to tweak your information based on that information as well. So basic technology framework is basically the technology you have. So in other words, I know companies that have systems, different systems for everything. So in other words, for their front office operations, they'll have one. For their back office operations, they'll have one. For their Corporate banking system, they'll have one. They have a retail banking, they have one home system. So it's not integrated. It's not capturing the risk, capturing from all over the place. In other words, technology is very important to make sure that not that necessarily that you might have the newest, most cutting edge technology, but that your systems are integrated, are speaking to each other. Because if not, you might be doing an analysis based on the information you have from one system, but for some reason it might not be looking at information from another system. So you might be saying, oh, this portfolio is making a lot of money, yeah, because I'm making X amount of return. But you might not see, oh my gosh, there's a loss on this which I don't see, or the other way around. This portfolio is making lots of money. I need to exit these clients. They are not the proper return for the. It's not the optimum asset for me. But that same client could be generating a good income for you through other means which you may not be seeing on that particular system. So it's important to have integrated systems that speak to each other. So, or a way of making sure that if not, you will have to do it manually, and then taking all those parameters into account, you would make a decision. So, like I said, if you are looking at a simple deposit from a client and lending it to him, you're borrowing at 10, lending it at 11. Like I said, you might say, oh my gosh, I'm not making my return on this client. Why am I doing this? This is not the optimum utilization of my assets and liabilities. I have to change something. I have to start signing high interest rate or lowering my deposit rate. But you might not be seeing the fact that you're making fee income on this client. For example, you could be making foreign exchange income. You could be making LC opening fees. You could be making TT fees. You could be making other fees that are not necessarily feeding into that information that you see at a relationship level, at a bank level. Therefore, it is important to make sure all that information is in the system that you're using, and the overall technology supports that fact as well. So, in a way, information reporting falls into the technology side of it as well, but it also comes down to presentation. It's a mix of your analytics, your technology, and then how you report it. So sometimes I see that there's plenty of data, there's plenty of good information, there's plenty of good analysis. However, there is a very poor presentation of it. So for example, it might be going into lengthy reports that people don't know how to read. So the analysis is there, the technology is pulling it out, but you don't know how to read it. It's not presented in a proper way. It may not be presented to you in a timely manner. So for example, it might come to you every 2 weeks, when you need it every week or faster maybe. And the level of detail, sometimes I believe, in my opinion, sometimes too much detail is not good. Obviously, too little is also not good. So you have to give the right level of detail to the right person. So going up to, say, a CEO and giving him a huge report and say, okay, this is what I found out, although everything is there, is of no use. He is not going to read that. But if you give it to him in a one single page with the highlights in it, he knows exactly what you're talking. And then if he needs detail, he asks you for that. So sometimes the level of detail and the right amount of detail is very important. That's the point 4 as well. And then it should not be confusing. Like I said, it has to be given in a very, very concise and detailed. Please understand, concise doesn't mean giving information in a way that doesn't give the picture. It should give the right picture and then allow you, whoever is reading it, the ability to say, look, I want more information on this. Can you give me more details? And then you give the rest of the details you have. Always have all the details, always have all analysis, but the information reporting has to be due. Why is this important here? Because when you go for an ALCO meeting, and from an ALM perspective, you have maybe 2 hours, 3 hours. Like I said, it could be weekly, it could be once in 2 weeks. There are so many things to cover. you cannot have a detailed report in front of you to go through. And most often, at least in my organization, these reports are shared well ahead of time so that people actually read it before they come for the meeting. So it's taken that it's read. But even then, it has to be in a very concise manner so that they come prepared, having read something with all the other reports they have to read, they read that also and say, okay, fine, I'm ready now. I know what you're talking about. But the reporting has to be very, very well done. So performance management, measurement framework. So now this is an interesting thing. So you can ask, what does performance management, or basically HR way of looking at performance, the frame, how does that impact the asset and liability management of a firm? Can somebody answer that? Why is performance management important for the for determining the ALM and ALCO process? It has nothing to do with interest rates, right? But why is it important? Any question? Any answers? Still not 12 o'clock, so not lunchtime, but anybody take a guess? Can you hear me or not hear me? Hello?
You can hear you, sir.
Okay. Okay, so how does performance management feed into the ALM process of decision making? How does performance management feed in there? Okay, it's not direct, but it's basically coming from the concept of the company in terms of risk, taking risks. So, for example, I remember the first thing we talked about was the strategy of the company, and then the board of directors sets out that, okay, look, this is the overall strategy we want to follow. This is the risk that we want to, type of risk we want to take, risk, the quantum of risk. Yeah. So, based on that, people who run the business from an organizational framework point of view and operationalize it, basically have to decide, okay, in order to make this return, we need to do these things. So then the incentive for them to do that is based on how much they get paid at the end of the day, right? So if you're getting paid a lot of money to make a high risk decisions, you have the incentive to go out there and take risk decision because you're going to get paid by the return that you make, not necessarily the risk that you take. Yeah. So, but if you're getting paid for keeping the organization safe and making a certain amount of risk, then you also understand that, and your performance culture has to basically vary with that as well. So it all depends on how performance is viewed at. Obviously, you want to make money in the right way for the firm and do it in the healthiest and safest possible way without taking undue risk. Yeah. So at the same time, you need to make sure that you're making a sufficient return for your shareholders. If not, at the end of the day, there's no point in running the business if you're not doing that. So, but while doing that, if your performance assessment comes out and says, look, you didn't make X amount of fund money, so therefore we are not paying you incentives, or we are not giving bonus, or whatever it might be, you might be discussing, look, this is not, you wanted me to do this like this, it didn't. So the performance culture, the performance management strategy has to be in line with the bank's firm's way of looking at risk and how you make a return on the risk that you take. Yeah. So, for example, you might have a year where you have not achieved your financial targets, just as an example. Yeah. You might have a year where you're not hit your target, or you have just gone marginally higher or just flat from last year. But the company can turn around and say, no, we will pay you the same, a little more than you got last year. The reason could be that you have demonstrated in your activities how you've kept the firm free, safe from liquidity risk, funding risk, other risk factors. Yeah. Or there could be a year that you have exceeded your financial targets, you've exceeded your return to your equity holders, all that. But it could have been done in a very risky manner, where you have actually taken undue risk in the process of doing that. And maybe the firm still made money, but it is not within the guidelines of the thing. So the conduct may have not been the right thing. So if that is the case, then you roll back and say, oh, okay, fine. That means you did perform well, but I can't pay you as much because I'm not happy with the strategy that you employed. Our performance management framework doesn't allow me to pay you that. Pay you a very much more higher incentives or whatever. So the next one basically talks about about where the profitability comes from for a company. So it comes from three sources: your assets, liabilities, and then how you manage it. Yeah, so the other one is pretty basic. It talks about your credit spreads being higher. That's how you make money on liabilities. And then at a lower possible rate when you're raising liabilities so that you have a higher return there. Okay, I'm just jumping into slide 49, which is basically the compliance framework. So now you're talking, always remember you're talking ALM in the center here from a compliance point of view. Now you need to deploy your assets, you need to raise your liabilities, you need to make sure you are fully doing it in an optimal fashion, making NII, keeping the risk and the bank safe. You can be doing all that. But what is regulatory compliance? How does regulatory compliance impact this? How does regulatory compliance impact your ALM strategy? What is regulatory compliance? Can somebody answer that? What is regulatory? Anybody in regulatory compliance from the people on the call, on the class? Is there anybody from regulatory compliance? Okay, nobody familiar with it. Okay, so basic regulatory compliance looks at the regulatory aspects of the regulatory risks and regulatory compliance requirements of a bank. So what they will do is they look at local regulations, such in Sri Lanka, for example, and then they look at international regulations that will apply. And then say, okay, from a regulator's point of view, from various states, it could be the US Federal Reserve, it could be the Central Bank of Sri Lanka, it could be some other market that the bank is exposed to, and say, okay, these are the regulatory requirements that you need to manage. So when you're looking at asset and liability management, you have to look at what the regulator has put down as your liquidity ratios, capital adequacy ratios, your other regulations around lending, borrowing. Now, for example, you know that now, as a few days ago, the central bank imposed a maximum interest rate on credit cards, which is 18%. Technically, that's a regulatory cap. Now, the banks have to ensure that they maintain that. They can't exceed that. So the regulatory compliance team has to say, look, these are the regulatory requirements that we have. You can do your business, but we have to do it in that framework. So any asset and liability, so like going back to the same example of the credit cards, if you look at it, that's an asset the bank has. The credit card interest rates are the asset the bank has. What are we saying here? Where the previously banks were giving at 30% became 24%, now it's 18%. So that means the banks have a huge drop in their NII because the asset is now giving them maybe 6% less than what it was before. They have to feed that into their overall model and see what does that do to NII. But that comes from a regulatory compliance issue. So that has an impact on your whole asset liability management strategy going forward. So other one is control framework. So control framework is also easy. It comes from the operational side of things as well. It tells you, okay, these are the operational guidelines you have. This is the organizational structure. This is all the regulatory requirements. The control tells you, okay, how do you segregate duties? So in other words, it will tell you the Treasury back office cannot have any reporting lines into the manager of the Treasury department. It has to go to finance or different independent control function, so that they can't influence the Treasury guys to Treasury guys can't influence back office to process transactions that are not dual check. So the dual check has to be there, independence has to be there. Like that, there is a clear segregation of duties so that there can't be any conflicts or any influence from one business to the other business in the bank, and thereby where it will compromise the strategy that is put down, compromise the organizational framework, and compromise the operational guidelines that have been put down to implement whatever ALM strategy you have. It is done to make sure that there's complete independence and there is no one person taking a stronger or sort of using the system against you. So, for example, like I said, if I'm in the front office, I can obviously I take decisions. I will say, okay, go ahead, we'll do this transaction. That's done. The back office will validate that completely independent. So the treasury guy, the ALM head desk will borrow money, lend money, do all that, and manage the funding. The back office team will wait to see, okay, well, they've done the funding with, and they will do the independent reviews of this to make sure that everything looks okay. Yeah. So the control framework usually has about 3 lines of defense. One is the front office, where it looks at going out to the market, doing all these transactions, doing all that. Then it has the second layer of defense, where the second level of defense, where it basically looks at all these transactions done. Have they been okay? Okay, fine, looks good. And the third level of the control framework would be the audit, which basically looks at both of those areas. I say, okay, front office has done this, the corporate banking teams have done this, the retail banking team, they are control guys, the back office guys have done this, they've checked all this, that's fine. The audit will come in and say, okay, fine, everything looks okay, not okay, and they basically validate the integrity of the information that is provided. When there is a regulatory audit or independent audit from some other party, the auditor are the final ones who say these are the audits we've done and this is the transactions, this is the way we've done. So that there are many layers of control that are in place already. So again, we're talking about ALM practices here. It's about liquid to maturity of cash flow measuring net funding requirements. So we've touched that already. So now finally we look at the different techniques. I'm not going to detail here because that's covered separately, I think, and also Nishant has already covered some of this. We touched it in briefly as well. In terms of interest risk, there is maturity gap analysis, which we've done before. Duration gap analysis. So to take not only the maturity from purely 1 month to 6 months, but based on repayments of those or the way the payments are staggered, what the actual duration is, and thereby what the gap is there. Simulation. So you have various kinds of simulations you can do to assess the financial foreign exchange risk, interest rate risk, etc. So there are interest rate simulations that are there. Value at risk to see at a certain confidence level where your risk is. So there are various models. So those are all used, like I said earlier, to provide ALCO and facilitate the ALM process to understand where your rate risks are, where your liquidity risks are, and how you optimize on NII, taking those into consideration. Right. So now that is it. We are ahead of time, but I don't want to go into the next section. Are there any questions, please? It was quite a lengthy area, but not too difficult. Having said that, I would really like to see whether you all have any questions so that we have time on our hands, so we can actually address any questions you all have. Please do ask. Anything that is confusing, not clear, that you want to understand. Unfortunately, I can't look at your faces and ask you questions because I can't see any of you all, but it will be good if you can raise anything that you have now. You can always reach out to me separately as well. But if you don't mind, if you want to, because we have some time and I don't mind spending that going through any areas of difficulty that you might have. Sorry, Mohammed, you're asking. Oh, you all are putting questions up. My apologies, I didn't see that. Can you explain more about leverage? Okay. Could you explain systemic risk further? Very good. And how many times bank can leverage? Okay. So basically, Damin, the first I'll answer your questions. Thanks for the question. The leverage basically is you're referring to the asset utilization leverage. So for example, you have raised assets of 100 million, but your equity is only 50 million. Now, obviously, assets and liabilities have to match. So you have your equities and you have your deposits and funding that you raise from various sources. You could raise from your depositors, you could raise from interbank sources, whatever. So now, if a bank has assets of 100 and equity of 50, that means 50 million of it has been raised from deposits or other sources. Now, which basically means if you look at your equity utilization or the multiplier factor, EM factor, the impact of being higher means that you are having more assets raised vis-a-vis the equity that you have. So you are relying a lot on other persons' funding, other sources of funding to fund your assets. So in other words, you've lent a lot of money out. You're relying on 10 million, you lent 100 million out, you're relying on 10 million of your shareholder funding and 90 million of deposits and other funding. Now, technically, that is considered leverage, where you are basically, you're not just using your owner's funding, you're using a lot of funding from debt to fund your requirements. Yeah. Now that necessarily isn't a bad thing, right? But what it means is that if those depositors come and say, tomorrow I want my money back, or depending on the quality of deposits that you've got, the type of deposits you've raised, you could end up with a situation where suddenly you find that you've lost a good deal of your liabilities and you have only 10 of your equity, because the equity holders are the last to leave. They are the most sustainable long-term investors in the company. Yeah. And then the equity holders could look at this, my gosh, I'm holding on to 10, but 90 of this is other people who I don't know. I don't know whether these people will be in the company. So he might not look at that leverage from a very healthy manner, in a very healthy manner, right? And that could lead to a bad impression of the company. Now, in terms of how many times a bank can leverage, I'm sorry, I don't know the answer to that. But I think that will be based on that own bank and that internal regulations of the company. Maybe I'll find out that for you and let you know that answer. I don't have the answer for you at the moment. And now, Mohammed, you would ask the question, how could you explain systemic risk further? Okay, let me just pull that slide. You mean the one on slide 22, Mohammed? Is that the one you're referring to? Mohammed, is it systemic risk, but I'm referred to at slide 22, is it? Okay, so basically slide 22, it speaks about systemic risk. So what is systemic risk? So in other words, when you say a bank or firm is systemically important to a country, what does it mean? It means, like, if you take Sri Lanka, you have, say, the Bank of Ceylon, you have the People's Bank, you have a few big names, right? Now, those banks are deemed systemically important to the country, yeah, because if by any chance there is a situation where there is a run on the system, where, for example, one of these banks were to look like they were going bankrupt or something like that, yeah, that situation will basically come out where you will have a situation where, because that particular organization has, say, a majority of depositors, or it has a certain amount of importance in terms of how the market operates, that organization coming down can have a massive impact on the overall functioning of that particular market. So I'll give you a good example. If you look at 2008-9, the financial crisis that we had, yeah, what happened there? The whole concept of too big to fail, yeah, that is where it was demonstrated. Why did what was one of the main triggers for the financial crisis? One of the main was the Lehman Brothers. The fact that the Federal Reserve in 2008-9 didn't come in to support Lehman Brothers when it was realized that they were going into bankruptcy, sent a whole huge ripple impact through the whole financial system in the US and then globally, where it says, oh my gosh, the Fed is not supporting Lehman Brothers. Lehman Brothers had lent money to various people or borrowed from various people. They all came to take their money back from Lehman Brothers. The depositors and the people who had money there came in because they realized Lehman Brothers being so big, and obviously some systemic importance of it, and they were not getting support from the regulator, yeah, or whoever it might be, for whatever good reason or bad reason. They were said, look, you have to sort your own problems out. As soon as that happened, what happened? There was a huge run on the market, on Lehman Brothers, and subsequently a huge run on the market itself, financial market itself. That led to various other companies also falling into bad state, because the whole system sort of collapsed with that. So if an organization is systemically important, or if a firm is sort of very critical to the running of that organization, it doesn't have to be necessarily even the assets and liability number of depositors, but from any other aspect, from a funding perspective to a certain currency or from a perception of the market, whatever, systemically, if it is important to have. And in this context, what we were talking about here is how you look at financial risk, right? So if you have a systemically important organization that you fear will come under threat in the next few years, right? How will that impact your understanding of financial, your impact on your assets and liability mix or your own operational risk? What is the impact to your P&L or your financial well-being because of the systemic risk that we have? So for example, if I think in the next 3 or 4 years that there is going to be a huge financial risk to 3 or 4 banks in the financial system in Sri Lanka, right? That will then model my thought process around how I operate in this market. How do I make sure I mitigate that risk? What are the funding lines I should get as a contingency for that, right? So that systemic risk is there. Sometimes you can't actually hedge for that, to be honest, but you have to understand that is there. So again, I'll give you another example. In Sri Lanka, we have the ability to borrow dollars is not as easy as you know, right? So we have a liquidity risk, we have discussed that, but that also has a systemic risk towards the market itself. If we are not able to raise dollars and some of the banks are not able to raise dollars, how do they manage to fund their books? Will it be that there can be a systemic risk to the whole market as a result of that? So that systemic risk is very, very important. Mohammed, is that clear? Okay, if it is.
So the main function of the ALM is managing interest rate and liquidity risk.
That's correct.
When it comes to interest rate, when it comes to interest rate risk, like what could be the tools we can use? Like it could be maturity gap. Like, is there a specific tool used by ALCO?
Okay, so the tools are left to the Treasury Department to use based on the ability and the markets. In other words, what the ALCO could say, look, we should be fixing our deposit rates for X amount of time. We should be fixing our lending rates for X amount of time, right? That could be the overall strategy that is given by ALCO. Yeah? So they could give a very broad definition. Treasury will then come back and say, okay, fine, in order to do that, what are the tools we use? What are the tools we can use? For example, if they decide they want to lend money long term, the decision is to make sure that we have long term assets on our book, at fixed interest rate. Then what can they do? They can enter into, providing the market allows it, fixing their interest rates for clients, giving them the fixed rate mortgages at attractive rates, so that we establish a loan book that is a long term fixed rate. Yeah, or they can say, okay, fine, we will do an interest rate swap and convert some of our existing floating asset book into fixed rate asset book. Yeah, or they could say, okay, we will go out and buy long-term bonds with a 6-month coupons, basically, but basically making sure that they fix their rates by getting into a longer-term assets, so that they buy the bonds and park it in their books. So the tools are there in terms of how you can do it. So there are products basically. Yeah, the gap analysis and all that are basically tools to understand where the risk is. How you implement it come down to the products that you can use. Basically, the products you use are fixed term loans, fixed term deposits, interest rate swaps. As you say, looking at the gap analysis and then maybe doing what we call forward trade agreements where you have a mismatch, where you borrow deposits for 1 month and you lend for 7 months or 8 months or whatever it is. Different tools like that can be used based on the overall strategy that you want to employ to manage your risk.
When it comes to like as example maturity gap, in particular 1 month bucket, we can go for we can set a limit. When it comes to set a limit, what are the key points bank need to consider?
When you are setting a limit for what, Rushina? For the 1 month
maturity, maybe a maturity gap or something like example you can
okay.
get as.
So what happens is banks monitor their risk based on the concept of month millions or what we call PVBP, present value for basis points, right? So what happens is those days we used to call month millions, meaning if you have the month million concept will tell you for your liabilities are at X amount of month millions, your assets are at this amount of month millions. Then you decide for yourself, okay, is that gap too much? And then you sort of put in parameters to reduce the gap. But now we have something called PVBP, which is present value for basis points. In other words, what it's saying is for each basis point movement in your portfolio that you have, you will make $1,000. Or if it goes down, you will lose $1,000. If it goes up, whatever way, you will make $1,000. That's just called present value for basis point. That calculation takes into account your deployment to assets vis-a-vis your raising your deposits, and then all the maturity mismatches that you have as well. But that's done through a system. Now, yes, you can have a how can I say, bucket by bucket, monthly bucket by bucket thing, but it's not a very efficient way of doing it, because it could be a case that raising money, for example, on a particular bucket or lending is the strategy you want to employ, and you might be doing it for a very long term. So you can't have a cap on how much you want to do on either one, because if you do that, you're restricting yourself. So how to look at it is looking at it from the overall portfolio perspective and seeing whether that risk that you're taking by doing it, whether the gap is increasing or whatever, through an overall portfolio perspective, and thereby then modeling it in such a way that then you can shift it if you want to. But you can have monthly gaps as well, but I don't think that's a very efficient way of managing it.
You mean the PVBP is the efficient way of managing this thing?
Yeah, so what it will tell you is for each basis points of interest rate movements, how much your PNL is going to change by. Take into account all those parameters basically.
Okay. When it comes to monthly bucketing, it says you can up to that amount, like you can go plus or minus, something like that. No, they
You can. That's right. But then how do you know that's the correct thing to do? I mean, you might hit your cap, right? And you might want to do some more, because that might be the right way for you to model it, right? So then you have to always look at exceptions. And it might not be taking risks that you have in other areas as well.
Yeah, that is true. That was the same question which I have. How can Treasury guys can set the maturity, like bucket limit? What are the things they consider? Like,
no, I don't think you can, because what you need to do, that's why it's called present value, PVBP. You're not checking.
Correct.
You're taking all your interest components, your duration, your tenors into account and modeling it to one period and say, well, this is your risk for 1 basis point. So if your risk is increasing, or because you increased your assets on your book or whatever, then you know either it's that or because your duration has increased.
Okay.
Or your tenor has increased, right? If your tenor has increased and your assets are the same, that means you're taking more and more gap there, or maybe you're extending your tenor. And it's taking into account, because your PVing everything is taking into account into one thing. Is okay, this is it. It's $5,000, $5,000. So if tomorrow interest rates move by 100 basis points, you know exactly what the financial risk to the bank is from that.
Yeah. You mean that can applicable that can be applicable for this? We have this currency wise balances, no, like if it is LKR or if it is foreign currency, you can apply it directly.
You can.
Yes.
You can. But most likely you can have overall PVBP and you can have it by currency as well. At a bank consolidated level, or you can have it by each currency as well. Remember, Treasury is the central point where all the interest rate risk is bought in. Yeah. So they have the ability to look at it and say, okay, fine, taking all the risks, the commercial surplus, the money that we've raised, the assets that we've raised, they have the ability to model all together and say, we are buying Treasury bills, we're doing this, we're doing that with the commercial surplus that we have. Therefore, this is the PVP risk we have on the book that we have, because none of the businesses will carry that risk. It sits within the GM business, global treasury. So they have the ability to bring it down to a single number and say, this is the overall rate risk of the bank.
When it comes to treasury bill bonds, I have seen this PVBP is calculated. That is specific for treasury bill or bond. That also
That's
can
correct.
do that.
That's correct. So it's basically for treasury bills and bonds that we mainly use it, because what happens is, if you have a commercial surplus in your funding, you will deploy it to something like that. Yeah. If you have a deficit in your funding, if you have a deficit where you have lent more to your customers and you don't have extra money to put on treasury bills, then you go into the money market and you will borrow.
Yes.
So invariably, if you are surplus, because you will have a surplus on a long-term basis if you are funding in such a way, then you will deploy that from a trading perspective and look at it from there. But you cannot say you are capping your 1 month with month millions, like monthly caps, etc., because all that feeds into interest rate risk, which all comes down to treasury and say, okay, fine, this is how you're going to manage this.
And what are the exceptions that ALM can approve? Like sometimes when I
mainly
go into our
mainly on the transfer pricing. So, for example, if you have if you are in the ALCO and you have a transfer pricing document, right, that says, okay, these are the ways that you're going to, this is the rate at which you're going to buy deposits into Treasury, lend to Treasury, etc. Now, sometimes ALM, Assets and Life, the ALM desk, not ALM desk might think, okay, we have this strategy, but we need to raise extra money for the bank's own deployment and whatever. So now you have agreed with the retail banking team that you will pay them the treasury bill rate for the deposits they raise from their clients, right? But you realize now, okay, bank has a funding requirement going in, sudden emergency funding requirement that has come up. Your normal transfer pricing says that we are paying depositors 5%. And then the T-bill rate is 6%, will say, and your treasury is buying it at 6%. But the ALM will say, no, we will make an exception. We will buy these deposits in at 7%. Not the T-bill rate, we'll pay 0.5% more, 1% more than the T-bill rate. You go out and pay your depositors more because we need the money. Now that's deviating from the transfer pricing policy, right? But it's giving you the exception so that you can actually go out and do it because you can see there's a risk. And you can't wait for the next document to be reviewed or anything like that. You need to make a decision quickly. And the guys who can see it are the treasury guys, the ALM guys sitting there. So they come and say, okay, I will give you this. Please go out and raise more deposits. That kind of exception.
Okay. Sometimes some dealer limits, like breach of dealer limits, also used to put to monthly ALCO meeting. Like, is it will it come under ALCO purview?
What limits? Like, what limits I talk about? Foreign exchange limits, is it?
Yeah. Sometimes if one particular limit, transaction limit of the head of the dealer, his limit also exceeded. If the ALCO says you need to put into paper says you need to put into ALCO and take the approval, get the ratification, something like that.
Okay. Generally, what I have experienced is that any limit has to be approved by the risk team. Any exception to those limits also has to be approved by the CRO, the controllers, chief risk officer team.
Okay.
If it's going to ALCO, it has to be because it's a long-term requirement that the limits have to be changed because of certain transaction that need to be done or certain activity that needs to be done. If it's a breach, generally it will go into a different governance forum where it is documented to show that, look, there has been a breach like this, because it's a control lapse. It's not a, it's a control lapse that has to be, obviously people have to vet it and say, okay, there has been a breach like this. These are the control parameters that have been breached. These are the ones that we need to do to mitigate it in the future. So there has to be certain operational incidents that are raised, approvals that are taken, certain escalations depending on how big that breach is that have to be taken into account. So it is not a really an ALCO thing. It is more a functional risk-based approach that is taken. Because breaches will happen, and depending on the type of breaches that happen, the level of escalation changes, but not necessarily going to ALCO itself.
Okay.
Okay, thank you very much for the questions. Anybody else, they can message me as well. Thank you, Daminda. Thank you, Mohammed. Thank you, Ruchira, for the questions. And basically, I'll stop there for the moment. We will start off next week again on the second section for ALM. Like I said, we'll go on for around 4 or 5 more lessons, depending on how it flows through. And then let's see how it goes from there. Yeah. Thank you very much for your time, and have a good day. Yeah.